Should be recording. Yeah, we're recording. All right, let's share our screen. So, welcome to Forex Fridays with Deontay. We got a few things to talk about and a few things to just go over and reiterate as always. So, hopefully, you guys had a great trading week. If you didn't trade, that's great. There's no risk to your equity. And if you did trade, hopefully, you traded with great risk management as well. So, we're going to begin. So, I believe you guys can see my screen now. If you can't, just let me know. You should be able to see my screen. All right. I'm gonna get the chat open on the side, just in case any questions come up while we're talking. All right. So what we're gonna be talking about for today's agenda is the weekly range review. So we always start off with the weekly range review. I feel like it's a very simplistic way to go about talking about what the week has done. I'm going to talk about UJ, DXY, and AU. We're keeping it short and brief. I realize when I talk about a lot of pairs for the weekly range, it could take a while. So we're going to keep it short. So two pairs, basically DXY and UJ, that are directly correlated, and then AU, which is inversely correlated. So we at least touch on a few things. After that, we're going to jump right into interest rate differentials, and then we're going to talk about identifying trends, and then we're going to talk about smash candle ideas by Larry Williams himself. So let's look at UJ. So as you can see, we have Sunday's opening price, SOP. You might see weekly opening price on the other ones that I annotated. It's no different. It's the same thing. So don't be confused. Tomato, tomato. Weekly opening price is the same thing as Sunday's opening price. This is our opening bid for those that know. Anything above this price point is going to be a premium. You're going to most likely find ideal selling conditions here. Same thing, vice versa. When price is below here in a discount, you're most likely going to find ideal buying conditions down here. So you're buying cheap or you're selling expensive. That's the most ideal scenario for you as a retail trader. It's most safe to take those odds. Looking at this though, you can see how price is reacting around Sunday's open price. You can see on Monday multiple times, even Sunday itself, when it opens multiple times, it taps it, it even consolidates around that area. Monday gyrates a bit around it, runs away from it during that news. We could even see Tuesday taps right back into it again, rallies back up, falls through it, is below it, and then finally Wednesday makes the low of the week and runs up. And Thursday, actually Friday makes the high of the week. So we can see that there. But all in all, you can see where the market makers or the algorithm is most likely finding its best buys and its best sells. The best buy was on Wednesday. This is all hindsight data, of course, but it teaches us the best buying opportunity came near London close or New York session here. So around 9 and 10 o'clock, we're below Sunday's opening price. Cheap, the ideal buy condition unfolded there. Vice versa, we could see the ideal selling condition could have been on Monday or even potentially Tuesday as well. And we're going to look at some of these days as well and looking at specific ideas. So let's jump into Monday. So looking at Monday, we have the New York session model idea that unfolded. So let's take a look at that. Many people say, you don't ever talk about the New York model or the London model. We will. We always do. We always do. So let's bring it back to London close. Let's go on the 15-minute time frame because that's where I like to start my liquidity pools on the 15-minute time frame. So we had news there, PMI. So I'm not really concerned about the news. The news is the excuse to move the price action very fast. The news is the excuse to get a lot of retail traders into the market so that the market makers can use them as sponsorship. That's how I view the news and my ideology. The New York model is going to be taking 5 a.m. to 7 a.m. right here, this time period here. Let's bring it back right when it hits 7. Let's point out a few factors as well. So we can see at one point at a time, it drops below Sunday's opening price and then rallies up. And now it's looking to be above midnight opening price. So if the true day open for the day, 12 a.m. noon, New York Eastern Standard Time, price is starting to get above that price point, and it's above Sunday's opening price while going into 7 a.m. The New York model is essentially just utilizing The liquidity pools we have within this dead zone. The dead zone is going to be between 5 to 7. I call this the London lunch because it comes after the London kill zone. So this is the London lunch. That's going to be 5 a.m. to 7 a.m. It's a very simple idea. Not to say it happens every single day at the pair that you're watching or tracking, but it does happen pretty often. 5 a.m. to 7 a.m., we're going to mark off our liquidity pools via 15-minute time frame. Here 10. So we got 7 to 10. Let's not forget that. That's the New York session, which is going to be 7 a.m. to 10 a.m. All the time that I'm referring to here is all New York Eastern Standard Time. I live in New York, right? Everybody asks, where do you live, Deontay? I live in New York in the United States. So I don't really have to change. Like when I look at my phone, I know what time it is here in New York because I live here. But if you don't live in New York, I believe TradingView would allow you to change your setting to UTC-5. You should have your charts acclimated to New York time once you set that up. Now, there still may be confusion, but if you are lost, please ask me. I know there's plethora of information out there that would tell you how to set your charts to New York time and find the kill zones. 5 a.m. to 7 a.m., we're looking for swing highs and swing lows that are unbroken because that's where the liquidity pools are most likely residing. It's the most obvious areas. Now, you could do this on the 5-minute too, but I preferably like the 15-minute. So we got a swing high up here. Now, what's above that swing high? That's going to be buy-side liquidity. What makes this a swing high formation? Well, because it's a candle that's between a lower high on the left and a lower high on the right. And the candle in the middle is going to be your swing high. So if you take off the annotations just to view it, 1, 2, 3, a little quick overview, that's a swing high formation. It's even confirmed because that low of that candle here, the swing point, it's been broken by this candle here. So it's even a confirmed swing high. Vice versa, we have a swing low down here. 1, 2, 3. It only takes 3 bars. So you can see here, when I say 3 bars, I'm talking about candles. It only takes 3 candles for a swing point to form. It's a very quick movement in price. The algorithm is methodically doing it in 3 bars. Now, it doesn't matter what time frame it is. It's going to be doing it on that time frame in 3 bars. This could be on the 30-minute, the 1 hour, the 4 hour, the daily, weekly, monthly, even the yearly chart. It's doing it in 3 bars in these swing formations. A swing low is basically the lowest point between 2 candles that has a higher low on the left and a higher low on the right. You can see that there. And it's confirmed because the high of that candle is broken. So let's bring back the annotations. So that's that swing low. I'm going to mark it off in blue. I like to keep my lows in blue and my highs in red just to be color coordinated. At this point, I like to mark off the opening price of the actual session as well. And that's not it. It's right here. So that's 7 a.m. And we'll make the line more apparent. So that's 7 a.m. So that dashed line there that we can see, that's 7 a.m. opening price. So we have a lot of confluences here. A lot of confluences. So we have midnight opening price. We have Sunday's opening price, the weekly open. And we have the New York sessions opening price. So I'm stacking a lot of these things on top of each other, but they all have the same meaning. Anything above the opening price is a premium. Anything below the opening price is a discount. Play it forward. You can see we haven't broken any liquidity pools yet here. Now, at this point, see this one at 7 a.m.? If the next candle does close, and I want to make sure I'm looking at this right, it is confirmed. So this itself is a swing high. It forms right at 7 a.m. So I would also consider that a part of the London lunch period because it's inside that time period from 5 to 7. That's still a swing point. Though it's confirmed into the session itself, it's still a swing point. So we would mark that off as well. So that's a swing high. So we got buy side liquidity pools, sell side. Let's play it forward. You can see what happens. Price comes up, takes out that buy side liquidity. At this point, I would go on the lower time frame and look to see if we have a potential short opportunity. Why am I going short? People may ask. Why? Because we're rating liquidity pools, we're breaking highs, and we're in an overbought condition. We're overbought from the session standpoint. We're above the New York sessions opening price. We're overbought from a intraday daily standpoint. So if the true day range from midnight, we're above midnight opening price. And from a weekly perspective, we're also above Sunday's opening price, or the weekly opening price. So we have three confluences that are stacked on top of each other saying that we're in a premium and we're overbought. I don't need an indicator to tell me that we're overbought because the price action is going to tell me that. The candles themselves already give you all the information. It's just the way you interpret it that will allow you to get closer to what it's actually saying. Price comes up here. At this point, I'm going to be concerned for sells. I'm not going to be concerned for buys. Going to be concerned for selling opportunities here. So at this point, I would scale down. Now you could scale down to the 5, the 3, 2, or 1 minute if you would like. Me personally, I like to use the 1 minute. As you can see, that's that 15-minute swing high that was formed, broken right there. Price runs up. And we're waiting for an entry technique to go short here. Now we're not chasing price at all. We're waiting for specific entry points. Now the entry model that I like is simply swing low, broken with a fair value gap, since we're looking for a sell opportunity. And it's going to be vice versa for a buying opportunity. And we're going to go through a plethora of examples. So let's play it forward to see what happens. So we're playing it. We even get up to this liquidity pool. So we raid this one too, right? We raid the highest one up here too. At this point, I'm still waiting. Am I initially going to go short off that break? You can, but I'm not. Because what if I go short here and price runs another 30 pips up? I'm going to be in drawdown. So I don't like to take that approach. Just because price breaks the high doesn't mean I have to go short right there. I want to take as less risk as possible, right? Little risk. I'm trying to minimize the risk. Yes, I can short here, and it could be a great turning point. But if I were to short here and price were to continue going higher, I would be upset and being a lot more drawdown. That would also cause a lot of other psychological things to occur. I don't want those things to occur mentally because trading, a lot of it is mental. So if I could take a lot of these stressors off my mind, I will have a better performance throughout the session. Let's keep playing it. Let's see what happens. We even got a fair value gap here, right? Look at this. A very small, and look, price does continue going higher. So going short there would have been very upsetting. Tiniest fair value gap. Let's make that more apparent for you guys. Fair value gap right there. Very small. Now that used to be my old entry technique for those that know the Asian session library or Asian session model. The very first fair value gap that forms after breaking some type of liquidity pool was going to be the one that I take to go short. And we even had one down here too. Look, notice this fair value gap completely fails, right? Price completely runs right through that fair value gap. No real displacement, no real speed. It is technically speed, but is it speed to the point where there's a market shift or a market break? No, not at all. There's none. Before that used to be my entry, and I realized that that entry tend to put me in a lot more drawdown in many case scenarios, and I didn't like that. And it was actually a fellow trader that was in the chat that mentioned it to me, and I believe they actually commented on the video, and I was like, you know what? They're right. This entry technique tends to put me in a lot more drawdown. I need to adjust this model. I need to find a different entry technique. And I figured out that the fair value gap that breaks the swing point tends to be more feasible and tends to hold up a lot more, allows me to adhere to less drawdown. Let's keep playing it forward. Look at that. Look at how right price keeps running. It's running many pips above this high. Just keep going. And finally, look, we got another fair value gap here to the downside. Now, could this be the one that respects price and continues going lower? Yes, it could be. But how would we have determined that it was going to be that one? It would be a very hard one to filter out. Many people would not probably speculate this one because there were multiple other fair value gaps as well that formed that we could have taken, but we did not take. I'm surprised. Did I delete all of them? I guess I did. I thought they were still on the chart. There we go. Because I want to keep them on the chart just to show you're not just taking any fair value gap. There we go. So this could be another scenario. But notice you had to go through that one, draw down. You had to go through this one again, draw down again. And now we get into this. Now this could be the turning point because we're getting into what, 8 o'clock. Now, most people know the heart of New York session is going to be around 8:20, 8:30 CME open. news embargo lift. We got other things that are going to impact the New York session here around that time period, around 8 o'clock, 8:20, 8:30, and you see that we're really up or really low, and you have other confluences telling you that we're overbought, oversold, you might have that pivotal moment within that time period. So don't be surprised when you see around 8:30, 8:20, you start to see the New York session start picking up speed towards the opposite direction. Sometimes it's a continuation, so price can continue trending up, and we see that often as well. That's another scenario. Let's play it forward. And I believe this is when we're about to, nope, we don't got it yet. So we got another fair value gap right here. Another fair value gap, right? Do we have a swing low that's broken with this fair value gap? No, this was not one. Notice these are clean lows. Look at the low here. Look at L. Look at when I hover my cruiser right here at the L. 148.62. 148.62. These are double bottoms. Now, could this be another entry technique instead of just looking for the swing low and looking for a double bottom that's ran through with a fair value gap? It can be. And that's something you would possibly have to study if you want to use that as your entry technique. Because I've been studying that myself to see if I would allow this as an entry technique. This fair value gap that breaks the double bottom. Let's keep playing it. Right, we're going to keep playing it through until we get a fair value gap that breaks a swing low. So keep playing it, we're playing it, we're playing it. And there we go. Look at that. What's that? Fair value gap here. And we're going to change the color on this one so we can see that this one is different from the other ones that we're looking at. So we'll change it to, we'll make it blue. This fair value gap is breaking a swing low formation. Listen, pay attention, because I feel like it hasn't been clicking for a lot of people that's been watching or hasn't been watching, because I've been showing this entry technique over and over again. And I just want to keep reiterating on the topic. This entry technique is a fair value gap that sweeps a swing low formation. Look at that carefully. 1, 2, 3. That's a swing low. There goes the speed and displacement to the downside. That swing low is inside this range from this fair value gap premium to this fair value gap discount. Between. It's not on the premium and it's not on the discount. It's in between those levels. So this would be an entry technique. What would I do at this point? I would look to go short inside this zone. You also notice, where is this PD array forming? Is this PD array forming? And this is for the chat, for anybody to answer. Is this forming above 7 a.m. or below 7 a.m.? That PD array. Anybody in the chat can answer this question. So I want to interact with you guys. Anybody can type it. Is it in a premium? Is it in a discount? Where is this entry technique occurring? Above. Good job. Appreciate it. Good answer. It's happening above. So immediately already, we can see we're increasing the quality of our entry. We're not selling in a premium. We're not selling in a discount. We're selling in a premium. So we're still putting more odds in our favor. We're not waiting for price to come down here and then start selling. No, we're waiting for price to get above the open and then find a selling opportunity above 7 a.m. That's what we're doing, because we want to sell in a premium. It's just ideal. Do not get confused ideal for the end all be all. I feel like a lot of people get that confused. It's not the end all be all, because there are conditions where you will be forced to be selling in a discount no matter what. But if you're a picky trader and you're someone that likes to stick to certain things like me, you will never take the selling opportunity most times in a discount. You will always wait for the premium sell. Same thing, vice versa. It's ideal to buy in a discount, but that doesn't mean buying in a discount is only going to occur, because there could be buying that's happening in a premium as well. And you will be forced to buy in a premium if you're looking for trade setups for the day. You come into the day as a day trader, you're looking to make money, and you're someone that's really aggressive, and you're like, yo, I gotta make at least $100, or I gotta make 1% today, 2%, whatever that is based on your equity. You're going to be forced to buy or sell in certain conditions. But here, I'm adhering to putting everything probable on my end. so that I could find a great sell condition. So what would I do here? I would sell at the bottom of that fair value gap, the discount side. Now, I don't know how far into this fair value gap price is going to fill. It could just tap just, let's get rid of this real quick. Let's zoom into this fair value gap. Let's talk about this. I have no idea how far price is going to pull into this fair value gap. I don't have the information. I don't have the IQ. I don't have whatever it is to figure out how far price will actually reprice into this fair value gap. I have no idea. I can use tools and measurements and take an educated guess, but odds are I'm just going to be wasting my time. I'm just going to take the first possible entry available to myself, right? Institutional order flow, drill. Price goes into it. Soon as it touches it, you're going short. Where would you place your stop loss? Your stop loss ideally would be above some type of swing high formation, because if the market's going to go lower, right? This is trading IQ. You got to be intellectually sound here. You got to understand how markets will trend. If this is going to be a short-term trending environment to the downside, we would suspect price to not break swing highs. We would allow them to protect the swing highs. They leave it unbroken. They leave that liquidity pool open. They don't want to run it, because in this swing high formation, that's where the algorithm most likely was selling to. That's where the market makers was most likely selling to. And what did they do in that swing formation? They got retail traders probably to chase price long to go higher. That's what swing points tend to do. And that's how I view it in my ideology. Swing points are just turning points that catch a lot of people off guard. And that happens on the 1 minute, the 2 minute, whatever time frame. So we're going to place our, where is it at? There we go. So we're going to place our entry at the discount side, and we're going to be looking for our classic one-to-one. I think my classic one-to-one is always going to be 15 pips. For some reason, I feel like it's just a sweet spot. It's just enough for me to adhere some drawdown, and it's just enough for me to get into a great range of target. So we can see what I mean by that projection wise. The projection of this trade idea gets me back to 7 a.m. I like to see that. I like to see that my projection of my trade idea is at least getting me back to fair value. Because if the New York session is going to cross back down, it's going to have to, it has no choice but to touch 7 a.m. again. Has no choice. It's either going to keep going up and not return here, or it's going to come down here and continue crossing the line lower. Let's play it out. Price trades up. And notice how price completely fills in this area. The entire thing. The entire fair value gap is rebalanced at this point. Now, people may speculate and argue, say, well, at this point, wouldn't you say this is bullish at this point? No, I would not. Because if I am focused on the sell opportunity, I am not going to abandon the idea, because this is where things start to get wishy-washy. People can't ever pick one side. You need to pick a stance. You need to eventually place that buy, place that sell, and hold it. And hold it all the way to stop loss, or hold it all the way to TP, until you start to get more experience and you start to get more trading IQ and you start to get intellectually sound about the markets. You will be able to call off trades and say, you know what? I think this trade is actually going to turn around. I have this gut feeling that this trade is going to run to my stop loss. So instead of taking the full stop, let me just get out early. And that comes with intuition. I can't teach that, unfortunately. I can't teach that. I literally can't teach that. That comes with intuition and experience and things you see over and over again. But at this point, you would have to stick to that stance. You're gonna get on this horse and then jump off and get on another horse. Then you'll never be decisive. You gotta pick a side. You can't be nervous. And the reason I say you can't be nervous is you're gonna have to pick a side. You can't just keep jumping in trades and then getting out and closing it. And then you're just in profit a little bit. And then you're never going to really make profit. Or you're always going to be in drawdown a little bit. And you're always going to keep, digging the hole slowly for yourself to be in drawdown. So let's play it out. What happens? Boom. News comes around. And we get stopped. And that happens. You ain't going to win it all. But we can see, think about the idea here. Think about the idea. Where am I framing my setup? I'm framing it in a premium. Yes, you may have taken this as a selling opportunity, which would have been great too. This one as well. But I decided to stick with that one. Yes, some people may say, well, that's ludicrous, Deontay. Why not just take the one that has a higher fair value gap? Well, because sometimes I know that this can lead me into drawdown, and I don't like to take it. At times, I may take it. I might make that decision to take that. Or I might blend this fair value gap with other ideas as well, right? A mitigation block, a breaker block, a volume imbalance. And I might be able to stack a confluence to take this fair value gap or the next one or etc. But I'm just trying to show you guys to be disciplined and consistent. If you're going to take a certain entry technique, stick to it. And as you start to expand your repertoire, start to expand your arsenal, you will understand different methods of entry points. I just show it to the community in one simple way because I think it's easier to get across to other people. When I start talking about 20 different entry techniques, it's like, oh my gosh, there's so many to focus on. I want people to be very disciplined. People have short attention spans. Human beings have only decreased their attention spans. So I want people to be concise. I need to have your attention. And a lot of this happens at the beginning of a lot of these Forex Fridays videos or at the beginning of any video. That's why I try to hit it hard with a lot of information at the beginning because I have your attention now. Sooner or later, you're going to zone out. Only the most disciplined and consistent people are going to sit here and listen to everything. Sooner or later, you're going to zone out. It just happens. It happens to me too. I'm not perfect. But that's the idea here. Where we're reselling premium. But notice where the buying opportunity happened too here. Where did it happen? In a discount. Drop right below 7 a.m. And then the news at London close, boom, takes off. Right? Price just shoots right up. And where does this all occur again? Below midnight opening price. Below 7 a.m. opening price. It doesn't get back down to Sunday's opening price. So you had two confluence here, two out of the three. So it's still granted a buying opportunity here. And what happens? Price runs up really fast. Let's play it forward, see what happens. And price continues to trade higher. But in this whole move up here, right, this large leg up here like this, boom, 10 a.m. hits, boom. That's a fast candle, right? That happens in 1 minute, 60 seconds. That happens really fast. Whether that it ran up here in 30 seconds and then another 10 seconds it ran up here, here. At this point, you can already assume retail traders are chasing price. And what are they doing? They start abandoning their risk parameters. They start completely abandoning, oh, let me just drop a standard. Let me drop 5 standards. Let me drop 10 standards, right? They're now risking 3% of their equity, 5% of their equity, 7% of their equity if their broker allows them, right? Their leverage allows them. Max, some prop firms allow people to have unlimited what's the word? Unlimited lot size, which is really not safe for the trader, right? You're not putting a barricade around traders to help them not break these rules, which is why I like live, not live. Yeah, that's why I like live regulated brokers because they already have laws in place to tell you, hey, you can't place another trade because you're going to over leverage or you're going to reach full margin or we're going to automatically just wipe you out the trade. So I like that. But when you have other, brokers that allow you to go beyond, you just blowing accounts and giving them a lot of money. So there's no safety net here. People don't care because they're trying to make a lot of money in one night, in one session. They think it's just, oh, this thing is printing money all the time. You could be up 10K right now and be down 20K in the next couple of minutes. The same thing. And then your heart is all the way down. Retail traders chase price, large candle right here, large cycle. Same thing Larry Williams is talking about on the daily happens on the 1 minute. This 1 minute candle is like the bone or the toy that the dog likes to chase, right? They're like, oh my gosh, my favorite toy is out. Oh, we're about to go on a walk. Yeah, let me chase my owner around. And that's what this large candle does to retail traders. They start salivating. They're like, oh my gosh. They start drooling. Yes, a large candle. Finally, let me chase it. And what happens when they chase it? By the time they chase this large candle, it's so funny. By the time they chase that large candle to the upside, they are probably full margin and they're buying at the worst price possible. They're buying really high. They're expecting they're expecting the next minute candle, next 2 minutes, the next 3 minutes, or even next 5 minute, right? The next 5 minute candle, they're expecting it to explode up more too. Sometimes it does, but more times than not, it doesn't. That's a scenario a lot of people find themselves in after news drops. What happens the next candle? Psh, hard pullback, right? At this point, this is tugging at your heart, your emotions. You're now underwater. For those traders that were buying at the exact high right up here, 2%, they're down hard. They don't even know where they're placing their stop loss. They don't even know where they're placing their TP. It's just all random. There's no objective steps to how they're getting into the market. They just click buy because they see it running. Don't be that trader. Do not be that. Be disciplined. Find the entry. Be methodical. Be just like the market makers. Find the fingerprints, find the footprints, and use that. This is not a fingerprint. This is not a fingerprint. This is them enticing you. In theory, it could be a fingerprint too. And I can see how people would argue this. But this is not something I would say, oh, this is immediately going to be an opportunity here. It does shoot off a lot of red flags to me and it alarms me. It tells me, hey, wait, because retail traders are chasing. It may continue going long, but allow it to flush out the retail traders. What happens? Next couple candles keeps pulling down, right? Goes down. This really gets, and then what do people do? They abandon ship. They get out of their longs, and what are they gonna do? Man, my longs are not working anymore. The market's against me because it's going down. So what do? They short foolishly, right? Because they can't either hold it any longer because they're gonna blow their account. So they need to make up their money. They're trying to revenge trade now. This is you see how quickly you start to fail. You start to immediately fail. You have no discipline. You have no consistent. You have no model. I ask people all the time, what's your model? Tell me step by step. Nobody can tell me their model step by step. What's step one? What's step two? What's step three? And what's step four? All the way to the entry point. You need to be able to tell me how you got there because it shows me that you have understanding and fundamentals and technical analysis to understand what to look for in the market and what you like to look for in the market to be successful. The Asian session model, all the steps that I show you, that's my method of being successful. It doesn't work all the time. No, it doesn't. It's not 100% right. I show it live, right? I show it in the Telegram channel. Yo, tonight's a loser, guys. Next trade, move on. Oh, it might be back-to-back losers. It sucks. Tonight's a loser. Oh, tonight's a winner. But then all of a sudden, this winner happens to run 100 pips for some reason. This winner happens to run 200 plus pips into the next day. So you got to be consistent. So that's one day. So that's the New York model. It's a lot that we're talking about, but that's the New York model here. Let's move on to another day, and we'll delete all this, and we'll come back to this day because it also ties into another thing that we want to talk about. So let's delete that. Delete this. We don't really have to delete everything. We'll keep it on the chart because we'll come back to it and reference it. Let's go back to the 1 hour. Still not done with this. The next day we're going to talk about is Tuesday. Let's play Tuesday out. So we have a New York idea. Let's pause it. Now, if you have any questions, please ask it in the chat, and I'll glance over and look at it. And to 10 a.m. Okay, cool. So let's go back down to the 15-minute time frame. So we have a New York session idea here. I believe this idea it's not a model. I'm putting idea because it's not the model fully. Go to 10. You will leave it right here. This is great. So let's go down to the 1 minute time frame. And you'll see that's the New York session there. That's the London session here. Just to show you guys. Asian, London, New York. Right? Cool. This is 7 a.m. This is all the way to 10. Cool. Just looking at this, right, with hindsight, we can see how prices, one, above midnight opening price right there. That's midnight. That first dash line here that you see here, that one's midnight. Let's put something there so we can see it. It's MOP, midnight opening price, MOP. This is SOP, SOP, Sunday opening price. So funny, right? When we get into this session, we're already overbought. That's just a known fact. We are overbought. And then we have 7 a.m. opening price, if I got that correct. Yep. So we got New York open right there. Look at the confluence here. 3 things stacked against each other here. New York, premium. The day itself, premium. The weeklies itself, premium. All premium. Look at how this New York session sells off. Sells off beautifully. Pulls all the look at how at the beginning, right, going into like 7:30, going close to like 8. You could not even 8, mainly just 7:30. You can see how price gets everybody to the wrong side. Boom. Retail traders are now long. They've been convinced that price is going to keep going higher. And you can see we failed to break a high here. So that's why I said it wasn't fully the New York model that I like to look for. In that scenario, the models that I look for, it's mainly a turtle soup idea. Not to overcomplicate the idea. It's all it is a false break. Because we know the algorithm, right? This is where the intellectuals will start to think to themselves, what scenarios can the market give me? We all know this one scenario is a false break, clear as day. And we know another scenario can be a failure swing. So instead of price making a leg higher and continuing trending higher, it fails to swing up there. And that's what happens here. It fails to break between, let's go 5 a.m. right here. Right? That's the London lunch, 5 a.m. to 7 a.m. It's the same thing we just talked about on Monday. It failed to break that 15-minute swing high here. Let's play it forward. Look what happens. It gets really close to it. Look how close it gets to that high. That's a 15-minute swing high. I already know because I just know it's a 15-minute swing high. If I just go down, just to be transparent with you guys. No, you're Deontay, you're lying. 15-minute swing high. Cool. All right, let's go back to the 1 minute. So it failed to break that high there. Let's see if there's any other. No, so you can see there's no other swing highs here. No other ones. It fails to get to that high. 7 a.m. opens, it runs immediately up. And what do I say all the time to you guys? Retail traders start the session. Retail traders are chasing the session outright. There is going to be a scenario where they are right and they are correct for chasing the price, and the market rewards them for that. But I am not going to be that gullible. I'm not going to be the sheep pushed into the slaughterhouse, right? The Judas swing that we're all taught by ICT. I don't want to be that gullible. I don't want the shepherd to lead me into to the slaughterhouse. So I wait. I'm waiting for something to happen. I wait for what? The break. And then I look to go short. Because that's also is a characteristic to trending environments lower. A shorting opportunity tends to happen after breaking a high. That is a fact. Nobody can tell you different. Do not let anybody else tell you different that that's not a scenario. That is a scenario. We see it happen all the time. I point it out to you guys all the time. The Asian session model is literally a false break. The New York session model is a false break. The London session model, and I'm talking about the models that I've came up with, right? I'm not saying I was the first one to come up with it and I made it, but the ones that I publicly talk about, right? That you guys know me for, it's a false break. It's a turtle soup idea because that's a scenario. Price fails to break that high. Look at it closely because I know I'm blind too. Sooner or later, I'm gonna need glasses. Right there, boom. Price does not break that high. Fails. Mitigation, right? We already know that's gonna be. We already know that's gonna be a mitigation block. If it fails, it gets back down to this candle's low here between these 2 points. How do I know this stuff? Because I've been trading for the last 7 years. This is a swing high. This is the swing high. If price gets below this swing low, what would we anticipate? Fail. Here, go short. Classic mitigation block. Classic. That's why I said it's an idea. I didn't say it's the model that I look for, but it's an idea. Price gets everybody long. You can see a large candle comes in. Large candle. And when you're looking at this, I want you guys to think about Larry Williams smash day candles. Think about how quickly they're turning the market around. Those turning points are quick, because it looks bullish. It looks bullish. They got the retail trader. Oh, it's bullish. UJ's bullish, right? And I have someone text me and say, "Yo, I'm buying UJ," and I'll text them, "Okay, it's possible." And then they come back a couple minutes later, "Man, what did I do wrong?" And I try to lead them in the right direction. I try to point them in the right direction as nice as possible. But sometimes you got to be blunt with people, because you can't always give them the answers. You got to let them experience the loss so that they can correct the behavior. You can't keep rewarding bad behavior and tell them, "Oh, better luck next time." No, do better. I want you guys to do better. I hold you guys to higher expectations. I'm not gonna baby any of you guys. But some of you guys are older than me. Like I said, I'm only 25. Price fails to break that high, and then notice how price breaks down. But I want you to see, look at this entry technique again. The same entry technique that I talked about, where this all starts. Yes, it fails to break the high. Cool. You can see that. But I want you to see how, where is it at? There it is. That swing low right there. Look at how price runs through that swing low with speed and gives you a fair value gap through it. We call this speed. So anybody that was watching ICT core content, and he was telling traders, what are the things that you should be looking for as a trader, when you first start trading? You should be looking for fair value gaps. And he wasn't calling it fair value gaps at the time because he didn't want to confuse people, right? Tomato. He called it speed and core content, right? This is basic ICT information. He called it speed, right? That month one, speed. Go look for speed. Look for clean highs. Look for clean lows. He was telling you to mark off those levels. And notice what happens around those levels. What happens when price breaks those clean highs? What happens when price breaks those clean lows? What happens on a lower time frame after it does those things? Look for this speed. Look at the speed. Same idea that we showed here. Just we failed to break a high. We have a failure swing. What happens? Price taps into it. Now, do we know if it's going to fill the whole thing? No idea. So what are we going to do? We're just going to go short right there. Institutional order flow entry drill right there. Boom. Taps into it. Look at how it taps into it one time, right? You want to be picky, right? Sometimes being picky leaves you in the dust. And it's okay to be picky. But at said point, you need to be able to get into this market. You can't keep missing opportunities. You're here to make money. So you got to get into the market. Notice how, in the last example we talked about, see if we could actually get it on a chart briefly. So look at that fair value gap again, just to compare. For this short idea, notice how price comes up and fills the entire fair value gap, right? Even has multiple candles close above it. So many people may say, I'm going to go long, but it still gives a reasonable amount of pips to the downside. It gives you at least 10. Let's measure that out just to confirm. Yes, it gives you max before it turns around. It gives you 13. It was 2 pips off from your TP. You can't be mad with that. You just can't be. And you only can be mad at yourself if you didn't pay yourself. That's the only time I tell people to say, "Hey, that's on you. That's on you, brother. You didn't want to pay yourself? Hey, let the market take it back from you. Keep being greedy, and you'll see where that gets you. It ain't gonna get you pretty far. But look here, one opportunity, bing, hits the fair value gap. Hits the fair value gap, gone. You need to be getting into these markets. You need to be getting into these plays. Because if you're waiting here saying, no, I want to get the mean threshold of it. I want to get the premium side of the fair value gap. Notice how it doesn't get here in this scenario. You'll be out of luck here, right? You'll be out of luck. So taking that first entry that is available at times is best. Boom. Now you could get fancy if you wanted to. Let's say you only risk half. Let's say your full max risk that you can take, that you initially want to take, is 2%. It's just an example. Let's say that you want to risk 2%. Okay, what can you do? You can take possibly 2 entries here, or even 3. Let's break it down into, actually, let's say your max risk you wanted to take is 3%. Okay, cool. Your first entry can be where the discount side of the fair value gap, right? The mean threshold of the fair value gap, and the premium side. Each one can represent 1%, totaling 3%. you'd have to obviously adjust each one based on stop loss on where price is to equate to 3%. And then you move on and you calculate that. But that's how you could, if you wanted to get a little creative, right? Sometimes being creative can lead you to the wrong thing. You're doing too much. I always like to tell people, hey, I do less. People like to overanalyze everything. I don't like to overanalyze anything. Hey, it stopped me out. Man, move on. Next trade, bro. We'll get it back. Don't worry. We only lost 1%. We only lost 2%. We only lost 3%. But when you start pushing into losing 4% per day, 5% per trade, ooh, that's tricky now. You're burning money, burning lots of money. And look at how price trades off. Phew, flies. Completely flies. Look at that reaction at midnight opening price. Why right here at this level does it give a reaction like that? Not to say we would have known it would have given a reaction like that, but with the hindsight that we can see now, when we look back at it, we're like, oh wow, look at how it reacted off of that level. Midnight opening price. Must be a coincidence. I think not. It's not a coincidence. These are significant levels. It's the same thing I showed with IPTA look back data ranges. Why are those 20-day look back highs, or the 40-day look back highs or lows, or 60-day highs and lows, etc.? Why are those levels so sensitive to the price point? Because for some reason it's significant. And the algorithm is using it to forecast future price action. It knew it was going to hit that and turn around and then potentially sell off again. It knew. Look how it gyrates around it again. Gyrates, 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 sells away from it. Boom. Major sell for New York session. Now, if we had to take this off and look at this on a higher time frame, let's say we go on the 5-minute, right? Because I know a lot of people who have been, mentored by ICT. ICT likes to say a lot about the 5-minute. Scale down to the 5-minute. See what's happening, what's going on in the 5-minute. Same thing I said. Got a high point, fail to break that high point. You look back down here. Where was that fail? Where was that low before the failure to break that high, before price got back down to that low? Here. So we look at that candle. It could be the last down close candle before the rally, right? Take this last down close candle. Here. We're on a 5-minute. Last down close candle. Let's draw it out. It doesn't return back into it. But we can see the idea here. So it would have failed. But we can see how we would have had our classic mitigation somewhere around here. Boom. Maybe you would have got knocked in by spread. Maybe you would have used a different time frame to use this analogy. Maybe the 3-minute, maybe the 2-minute, whether 15-minute, etc. But you can see how price is methodically doing things. It's not doing it randomly. Because if it was random, it would just do this all day. And if it was random, we could never have came up with this model. We could never come up with Asian session model. We could never come up with New York lunch model. New York kill zone model or London model. We would never be able to come up with models in general, because if it was random, there's no real way to gauge it. There's no real way to predict what's going to happen in future price action, because it's so unpredictable. If it's so random, it can't be random. It's coded. It's algorithmically coded. So we got to understand how price action works here. People say they understand how the market works, but they truly don't. Do they really know how it works? No. I'm not saying I don't either, but I do think I'm getting closer to the truth as the years go on. Right? As I gain more experience, I get closer and closer to the truth. The entries only get better and better. The models only get better and better over time. Doesn't happen overnight. Trust me, my first 3 years of trading was terrible. Terrible. Just picking random order blocks, picking random fair value gaps, picking this. Yes, I might have had a couple lucky winners, and I might have clapped for myself and applauded myself, but was I really sure about what I was doing? No, I had no idea. I had to do the repetitions. No idea. Let's go into another day. The London session model. So please, for everybody that says you never talk about this, I talk about every kill zone. Talk about every kill zone in the most simplest way possible. Let's play it over to it. Let's go all the way to it. Got price is under Sunday's opening price. Boom. Let's go over. want to get it to 2 a.m. So we got 2 a.m. Where are you at? It's right here. Sorry. Yeah, I definitely hate classes, man. To 5 a.m. There we go. So the London model is exactly the same as Asian and New York. It's no different. We're taking a dead zone. And we know that the market gives dead zones because they go into consolidation. When you start to study this stuff, you realize every single day at certain times, the market literally just stalls for about a couple hours in those sessions. And the largest stall session is the New York lunch session. That's 12 all the way to 8 p.m. That's a couple hours of stalling. You have short bursts like that too between the kill zones. So this is Asian here. This is 12 a.m. and then this is a dead zone. So let's just see how it looks. See how it Asian and in London. That's that dead zone here. So we're gonna mark off all our liquidity pools just before 2 a.m. or even including 2 a.m. because that could be a swing low too. Let's mark it off. So 2 a.m. comes out, price immediately comes down, knocks out that swing low, takes out that sell side liquidity. We also have this swing. Oh, what the heck? You have this swing high up here, buy side liquidity. So at 2 a.m. price quickly runs down. And I already know this large 15-minute candles are already getting retail traders short, getting everybody on the wrong side. Where are we in price as well? Below Sunday's opening price. So let's bring this over here. We're below Sunday's opening price. We also have midnight opening price. Oh, we got it over here already. We got midnight opening price. So look how price pulls traders in to the wrong side for the day already. Or it's enticing or getting people to be very optimistic for shorts. Getting them to go short. Oh man, that's a strong. You hear people say, "Oh, that's a strong 15-minute candle." So what? So what? Yeah, it's large, but it did exactly what it was. You could tell the market makers did exactly what they wanted you to think. Oh yeah, I'm a sell. They got you, right? They got you. When I hear people tell me that all the time, look, it looks bearish. Yo, man, did you see what gold did? Oh yeah, I know. It caught you on the. It caught you to buy and sell. It caught you to chase price. And a couple of hours later, I know you got stopped. Or maybe you got lucky because that could also happen. Retail traders do win. Price takes out sell side. At this point, what should I be doing? I should be looking for a long opportunity. Why am I looking for a long opportunity? Let's go back and rehearse what we're talking about here. We can see we're below 2 a.m.'s opening price. So we got London open. Just leave that as LO. London open. We got midnight opening price. And we also have above us Sunday's opening price right there. So we got triple confluence again for this day. And guess what? What day of the week is it? It's Wednesday. It's an ideal trading day. So you got so many things going on for you here. But if you don't know these things and you're not informed about these things, you never know what's happening in the market. I love when I go on Reddit and I see people posting, what did I do wrong? I'm like, man, you're just not informed. You just really don't know what's going on. You're just so stuck in that commercialized education. Trend lines, indicators, you're so stuck there. You can't even fathom that the market is rigged. You can't even fathom that the market is algorithmically primed to do certain things at certain times. You don't even understand that yet. Price sells off. Still selling, right? Let's go down to the 1 minute time frame. See what's happening now, right? We're below 2 a.m.'s opening price, London open. We're below midnight opening price, 12 a.m. We're below Sunday's opening price. We just ran a 15-minute swing low here. Clean lows too. Look at what it transcribes to on the 1 minute. Clean, relatively equal lows. You already know. You got your trend line users out here, right? Phantom trend line. People trying to draw these trend lines that have no it has no correlation to price, folks. And it's so subjective. I can draw this trend line in any other angle. 180 degrees, 40 degrees, 65 degrees, 75 degrees, 90 degrees. It's so subjective. So there's no real metric here. But the metric that I'm taking is clean highs, clean lows. That's a real metric. We can all say that for sure. We can click this and say that's the metric here. 147.91. That's a real metric, not that trend line. Price takes out that trend line, completely cooks the retail traders. Right? Everybody that was thinking, oh, it's gonna bounce, retest. They'll draw like you'll see them draw funny. I don't even know how they draw it. It's so funny to me. Like, who's teaching these things? Because I personally haven't taught. I've never been taught these things. But they'll draw the trend line like this, and then they'll draw like I'd be seeing stuff like that, and then you got another one like this, and then they got another one like this. I'm just like, bruh, you are lost in the sauce, man. It's played out. Let's look at all the fair value gaps to the upside again. We're doing the same thing. Let's start analyzing these things. After getting that 15-minute swing low broken, let's see all the fair value gaps that we get. Get one here, very small. Here to here. Sheesh. No, that's not a fair value gap. That's completely rebalanced. Got one here. Let's change this color. Change it back to orange. Right? Oh, I could take this one, Deontay, right? Let me just go long. Okay, go long. Drawdown. It hurts. It could still be a good entry, but the drawdown hurts. And it already puts you in a different, it puts you in a mental displacement. You're off your game a little bit because you're in drawdown. You're emotional. Even with the experience that I have, being in drawdown is not the best feeling, right? But because of the risk parameter and the experience that I have, you gotta a mental threshold, right? You fortify your mind a bit to not break or crack in drawdown. That just comes with experience and it comes with good risk management. Let's keep going. Let's keep going. There we go. Another fair value gap. Price just turned around. See, you probably was in a little bit of drawdown, and now you're finally out of drawdown, right? Another fair value gap there. Let's keep playing it. Another fair value gap here. Come on. And that's the one actually we're looking for, actually. Oddly enough. There you go. Let's bring it back a little bit. I'm going to change the color to blue because that's the one I want you guys to pay attention to. Fair value gap here, right? Just same idea that I just showed for the New York session, but in the London session. And for an opposite setup, instead of a sell setup, this is a buy setup. Why are we buying again? Because we rated sell side liquidity. And that's why we're buying. Zoom in so we can look at it. Look at how it looks like. Doesn't matter the candle. Someone the other day in the chat said, "Oh, is it the color of the colors of the candle or the close of the candles, right? The fair value gap, the way it's closing, and the sequence of candles. Like if it was all green candles going up, no, it doesn't matter. Once it's a fair value gap, it's a fair value gap. No matter if this candle was to close up green or this candle was to close down black, doesn't matter. Once we got that fair value gap, we know that's it. It's done. Now, many people are not trained to see things like that, right? Not I'm not talking about the actual swing high, but just the fair value gaps. You got to train your eye for those things. It's not an easy thing. I remember the first time I was trying to teach somebody that how to recognize fair value gaps, and it took them a little while, and it took me a little while too when I first started trading. To be honest, actually, no, it didn't take me a little while. My comprehension was pretty fast, but other people have other, levels of comprehension. And it takes a little while for them to get their learning curve, or just to adapt to the idea because they've already been cemented into a different ideology or methodology. This is completely new language to them. So it may not make any sense. But after a while, once you get used to seeing that, you'll be like, okay, I got it. That's the entry. Or that's the fair value gap. What would we do here? We're looking to go long, right? A one-to-one scenario, same thing. This is my day trading stop loss and entry. 15 pips. I like it. If I'm stopped, I'm stopped. I'm done. Now, could I go? Can I, even if I'm stopped, if I still have enough to risk for the day, could I get back in and try and mitigate the losses? Yes, I can. But do I risk the same amount? No, I need to cut my risk by half. It has to be less than the first initial risk that I took for the day or the loss that I took. And then we look to go long at this point. So they're long. And just play it forward. Boom, 15 pips. Boom, right? This looks no different to the Asian session model that we saw yesterday. Think about it. We had a successful Asian session model yesterday, which was episode 35 on YouTube. Looks exactly like this. The same formation. Not the exact same, candles and stuff like that, but the same entry, the same idea of breaking a sell side liquidity pool, the same idea of price being below the session's opening price, where the entries occurring, discount, buy, boom, done. These ideas are not happening every single day, but when it happens, it's an easy win. It's an easy kill every time. Doesn't take a lot of brain power to get to this, what I show here. It takes less than a few minutes. The only thing that takes long is your time because you don't know if the entry is going to happen at 2:15 or if the entry is going to happen at 2:30 or if the entry is going to happen at 3 o'clock, right? The heart of London. And you could also see here, it's odd. It's funny enough that we're talking about this. At 3 a.m. is when the market really starts to gear up again and really push its direction up. It does start a little earlier, but we can see around 3 a.m. is really where it starts to gyrate and then push up. So that's just a little more advice and little tips. Now, where did I learn all this stuff? ICT, of course. He has a lot of content. Go through it. Go through it. What I have on my channel, however, is everything that I think is fundamental to trading from a day trader, from a scalper, and from a swing trader. Everything that I thought that was resourceful from the mentorship, I comprised it to what forensic forex is and what Deontay truly is. That's it. I'm not gonna make any more, forensic forex mentorship videos 2024. I'm not because I already know what I'm looking for. I'm done. I'm done. And everything you see here is what I utilize. I tell people all the time, check the channel. It's there. Check the channel. Deontay, did you make a video on that? I most likely did. And if you don't see it in these playlists, then I don't use it. You don't hardly hear me talk about COT data. You don't hardly hear me talking about standard deviations or Asian session deviations or central bank dealers range or flout. I used to dabble in it in my earlier careers. You can go back on TradingView and you can see I used to post about it. I used to utilize it, but it really didn't click for me. It didn't click for me. Not everything is going to have to click. You don't need to know every single market maker model. There's about 12 that ICT publicly talked about, right? In private and public um medias. But there could be plethora of other market maker models, right? According to what he knows, or according to what he made, right? Their models. There could be a lot of them, but only a few maybe sound and resonate with you. You don't have to take everything. Take everything with a little grain of salt and maybe apply it here. Or apply it here or blend it with this and blend it with that. That's what I did. You even see I'm blending Larry Williams. I don't hear enough people give Larry Williams credit. And he was the one that, I guess, according to ICT, mentored ICT, or ICT had teachings from him that he took and he applied to his trading career as well. Right? Nobody talks about Larry Williams. At least the people that within the large scope of the space. Those that know. But popularity, you're always going to hear the forefront Michael Huddleston. And I give the guy his credit. I give him his flowers because he made me the trader I am today. But I also said, okay, if he said that he took teachings from someone else, oh, let me look into this guy too. Let me buy his book. Let me go on his YouTube channel. Let me see what he's got going on. And then I started to realize, I was like, wow, some of the things ICT does teach, he did get from Larry Williams. It's a no-brainer. If you read the book, you know that some of the concepts that ICT's gotten has been remastered or remixed from Larry Williams. And there's no shame in that because everybody does it. You optimize someone else's model. You study somebody else's model. You figure out when to sell, when to sell, when to buy. And that's the London model there. Right? Quick recap. What happened here? Price opened and sold. Price opened and sold. Retail traders are doing what? Chasing. They're looking for some type of break retest. Doesn't work here for them in that favor. Completely doesn't work. And then price turns around against them. Look at that. Look at how it's reacting around midnight opening price and even London opening price. Right? Look at that. Look how it's reacting around those levels. And what did we do? We went from sell side, boom, back to buy side. How many times have you guys heard me speak about this? I don't know. It could be almost 100th time, right? 1,000th time. Talk about this all the time. Purge, revert. All the market is doing purge, revert, purge, revert, purge, revert. Yes, there will be times where it just purges and then continuation pattern. You don't get no reversion, right? Price doesn't revert. It's not in that phase to do that yet. It decided to take this scenario, and that's the phase you're in, right? Price distributes, redistribution, continues, accumulates, redistributes, and continues selling off. Forced to sell in a discount. No way around it. And then the higher time frame trend most likely is bearish. And you'll see those sell-offs. You'll see 3 days in a row bearish. You'll see 6 days in a row sometimes bearish. And all those days, there might be times where there are a premium sell, but odds are a lot of the sells that are going to be accumulated are coming in by way of discount selling. Everybody, retail is going to be forced, while the commercial speculators and the market makers and even some large funds and privately owned funds are getting the best sells or getting the best buys. It's the quality of the entry that allows you to take less risks. That's a quality entry here. Quality. Because I'm selling below. I even adhere little to no drawdown. How much drawdown would this? And I'm not saying I took this trade, but just going back and saying, like, this is how I would have done it if I was sitting here watching the market. How much drawdown would I have taken if I would have taken this trade? Let's round it 7 pips down in drawdown. That's not bad. That's not bad. So you're risking 1% on this trade. You just gained 1% on your account on this simple idea. And if you were able to get a trailing stop that wasn't stopped out, you can see how sometimes the reward is much greater than what you were looking for. So keep that in mind, guys. Keep that in mind. That's the London session model. So we talked about the New York session model and the London session model. You guys already hear enough about the Asian session model. And I only talk about the Asian session model because that's the time I'm available to trade. During London, New York, I have other things outside of trading that I have to take care of. I'm just not available. There are times I am available and I will try to trade it, but I'm not going to look for it because I've already conditioned myself to say, hey, Deontay, this is what you're doing for the rest of your life, bro. You trade an Asian session every single day of your life. That's it. You're going to master Asian session. No ifs, ands, or buts. And that's it. As you get older and you progress during your trading career, you will start to decide on what you like to do. You can't pick everything, guys. It just doesn't make sense. I think that's the last. Yeah, that's the last example we have for UJ. So let's move on to DXY. I don't think DXY has any. We don't have any days to really talk about on DXY. We'll get back to this at the end. So just looking at the weekly opening price, right? We're still in the first topic of the video, weekly range review. This is what happened this week, Sunday to Friday. I don't like to trade Sundays. I don't like to trade Mondays, and I don't like to trade Fridays. These are the main days I really like to trade. I like to trade Asian session on Tuesday. I like to trade Asian session on Wednesday. I like to trade Asian session on Thursday. Done. Yes, sometimes Monday I'll trade it. But if I am trading it, it would likely be in a demo. And if I am trading it, it's just to get examples for the Asian session library or get examples for you guys in the chat, in the channel. So that you guys can know, like, hey, there are opportunities outside of just Tuesday, Wednesday, Thursday. And I know the days may be different depending on where you live, but these are the only days. These 4 days here are the only days Asian session occurs here. on Monday, Tuesday, Wednesday here, and Thursday in New York. There's no Asian session Friday here in New York or Sunday. I don't consider Sunday Asian session because it's not a full day. And the reason I don't like to consider Sunday is because it doesn't have that full accumulation that I'm looking for between 12 to 8 p.m. It doesn't have that because it's going to be mixing in Friday's New York lunch to Sunday's New York lunch, and then the Asian session trade would happen. I did see a couple times where the model did perform as it would step by step, but I think it's less feasible. So I completely opt out of that. And there's no Asian session on Friday. And I hate Fridays. I want to be relaxing, going into the weekend, trying to put my feet up, trying to chill with my girl. I'm trying to do whatever. Man, enough of the charts, bro. I put in enough work for the last 4 days, last 3 days. I'm done. There's no need for me to keep staring at the screen, hurting my eyes. But notice the sensitivity around Sunday's opening price. Boom. Look at that reaction. Hits it, hits it, hits it, stalls. Wednesday completely sideways. Boom, speed right out of the consolidation. Right out of it. And then price again here on Friday. Boom, hits it, reacts away, consolidates, closes. So it's important to mark these off in your chart because it can help you paint a narrative. AJ. Just look at AJ. So we got 2 days really to talk about. We're not going to talk about Monday because it's a Larry Williams smash day idea. We'll talk about that at the end. And you'll see how powerful those candles are. Let's go into what it looks like on the hourly. Look at how price is trading around Sunday's opening price. Look at where the sell opportunities are happening. Look at where the buy opportunities are happening. Coincidental? I think not. The best buy opportunity for this week for AU was on Monday, and it happened below weekly open in a discount. And it happened right when that news dropped, PMI. Right, price dropped down, got the retail traders in short, got them chasing price short, large candle down. I'm chasing the news. Yo, Deontay, the news came out. Did you see the news? It's strong. The job data is strong in the United States. Did you hear that, Deontay? Yeah, I did. Doesn't mean anything to me. I don't read the data. I don't read the data personally. I'm being honest with you. I'm being super transparent with you guys. I do not look at the data. The only data I really consider is the interest rate decisions. That's it. And we'll talk about how that impacts the foreign exchange currency or foreign exchange market. But just look at this. Let's get into Tuesday. Tuesday, same idea. We got 2 examples of London sessions. So nobody can sit here and tell me, do you have a video on it? I do. It's in the Forex Fridays videos. Got to be able to watch it. This is not for you guys in the Zoom call right now, and I appreciate your time here. It's not for you guys because I know you guys are here listening, and I appreciate your time. Some folks just ask questions. It can be a little annoying at times, and I love all you guys, and I respect all you guys. Sometimes you can't keep telling people over and over. Yo, it's there. You just gotta look for it. You gotta watch it. I do talk about it, and I don't ever ignore anybody, ever. We got midnight to 2 a.m. It's going to 15-minute. 5 a.m. This is midnight to 2 a.m. That's the Asian lunch. I call it the Asian lunch session simply because it happens after the Asian kill zone. Yes, we do know that these sessions tend to overlap and extend way further than what they are. According to what most people trade and what most people have learned in the industry based on what ICT has taught, right? And if you're versed in that world, you know that the kill zone that's it. Midnight, it's done. We're not looking about the extended time periods for the sessions. So when I say sessions, I'm mainly referring to kill zones. I think I confuse a lot of people, and I kind of upset a few people saying that. And I don't mean to offend anybody, but when I say sessions, I'm mainly referring to the kill zones because I'm not looking at the extended hours. I'm not. What's this? South side. What day is this? Tuesday. Ideal. think it's up here. Yep, that's the highest high we have here. All the way up there. Play it forward to 2 a.m. Price comes up. Doesn't break anything, right? Price comes up. It's at a premium right now. And let's keep playing it out and see what happens. Play. Play it forward. Play it forward. Play it forward. Boom. Sell side. So at one point in time, it looked like it was bullish, right? It looks like it was bullish. But then all of a sudden something happens and it turns around. Retail is yelling at themselves here. They're mad. They're upset. But man, it was going up before London session. And I thought if I would have brought going into London session, I would have won something. You could have, but the likelihood of that is probably less likely. You just randomly picking when to buy and sell. Just chasing price again. Sell side purge. What do we have available to us? Buy side. I mean, you also see there's buy side liquidity pools being formed inside the session itself because that's a swing high here. That's swing high, right? So we'll just mark it off here. I'll make the line a little apparent so we can see it. That's it there. We also have a swing high up here, right there. So you have buy side still available after taking out sell side. Let's go down to the 1 minute. Where is price when this all occurs? Price is in the discount. You can also see before this dropped down, it placed itself in a premium to sell off. And we got 2 a.m.'s opening price here, right here. A lot of lines on the chart. I like to keep it clean. All the time, and you'd be like, man, I don't even know what I'm looking at sometimes, dog. Like, bruh, clean the chart up a bit. So this is London open. Just write 2 a.m. open. 2 a.m. open. That's London open there. We have Sunday's opening price. This is here. SOP. And then we got midnight opening price, which is here. MOP. Triple confluence again. And it was a triple confluence for the opposite end too. Not saying we would have predicted this selling opportunity, but hindsight just shows us like, wow, look how algorithmic it is. It pulled itself in a premium above midnight, above 2 a.m., and the Sunday's opening price, and then it sold off. Wow. That's fascinating. Takes out the sell side liquidity. Cool. Now, at this point, let's look at every fair value gap that forms after taking out that sell side liquidity. Look at every single one. Not my entry technique. Nope. Got another one. Here. Could this still be feasible setups? Yes, it can be, but it's just not the one I'm looking for. I'm just trying to show you the difference between my entry and the one other people are looking for. Boom, there it is. And it forms right after 3 o'clock too. Right near the heart of London. Very interesting things that you see. Let's zoom in. Once again, nothing has changed. Look at that. Fair value gap. A fair value gap takes 3 bars or 3 candles. Since we're on the 1 minute, it takes 3 minutes to form a fair value gap. So there it is. 1, 2, 3. 3 minutes forms one. Swing high formation is broken with speed to the upside. And I'm looking to do what? Potentially go long here. Go long here. $15 pips. Done. Look at the projections though. My TP or my path of profit puts me back at fair value. I like when I see that. I like when my projections get me back to fair value. I like when my projections get me back to buy side liquidity. Here and here. Within 15 pips, I'm already back to a 15-minute swing high. Here and here. Play it forward. Price taps into it. Let's look at this closely. Completely rebalances it. Does trade back into that fair value gap there too. Trades even lower again. Let's keep playing it. And now we're in just all drawdown, right? And you can see price does stop us out. So I'm showing you realistic ideas here, right? Not everything is going to be a winner, but just showing you the process or the thinking behind it and how we would go about it. Price sweeps a 15-minute swing low. We're looking to take the counterparty measure against those that want to break out. This night or this morning, right? Or it's night, technically, it's still night. It's 2 a.m. in the morning, 3 a.m. in the morning. This night, price does not give us that scenario. We don't get the false break. But could you mitigate your losses? Yes. Could you flip back to being a seller? Yes, you can. There are methods and way to do that. Am I going to sit here and teach you all those methods? No. But you will figure out as time goes on how you can get back on page with where the market is most likely going to go if it's going to continue to sell off like this. And I can't teach these things because it comes with experience. I just can't. But once again, you see the idea of what I'm doing here. So that's on Tuesday. That's a London session idea. Failed opportunity. I'm glad to show the failed opportunity. Let's go on to another day. Stop. Way too far. 2 a.m. 5 a.m. Asian lunch. Buy side. I'm going to go through this a little faster here since we've got a couple examples underneath our belt so far into tonight's lesson. Sell side. Play it forward. Boom. Buy side's taken instantly. London open. At this point, buy side's been taken. Go down to the 1 minute. Look for the confluences that we have. We're above London open. We're above Sunday's opening price. This line here is SOP. That's Sunday's opening price, the one that's lower. And then we also have midnight opening price. But that's midnight, actually. This is midnight opening price. Correction. This is midnight opening price. And you can see we're above Sunday's opening price. It's all the way down here. So we're above it. We're in a premium. Ideal sell conditions happening in a premium. So we have some things that are lining up here for us. Break of a high, above midnight opening price, above 2 a.m. opening price. Great. See what happens. Play it out. Play it all the way through. Look how it pulls everybody long and then it goes short. What did it do? It went from buy side, again, opposite now. It purged buy side and went to sell side. Turtle soup. I like this scenario. I love when the market makers give me this. I love when the algorithm gives me this. I love that. And then when we look at this, see if we can see the entry technique that we're looking for. Can't take this fair value gap. Price doesn't even get back to this fair value gap. You see that? Swing low, but is it broken with a fair value gap? It's not. Right there. It's not. Another fair value gap here. Does price get back into that one? Yes, it does. You have another one here. So you have basically right here, you got a liquidity void. So it's all 1, 2, 3, 4, 5. 5 candles down. So for 5 minutes, a 5-minute candle was down. It was all sell side direction. Liquidity void here. Price trades up, rebalances some of that, and then sells off. but I'm looking to see if we get a fair value gap to the downside above 2 a.m. opening price that breaks a swing low. And it looks like we don't. Right? On the 1 minute. Think about this. On the 1 minute, though. But if we go down to the 2 minute, it may look completely different. So let's take this off. I say you don't have to be sticking to just the 1 minute. But look, there it is. Look at the 2 minute right there. 2 minute time frame. I figured because of that liquidity void, we would have one. 2 minute time frame. What's that? That same entry technique, but just via 2 minute. Speed through a swing low. Price trades into it, same idea. What would you do? You go short. Same idea and same principle. I like when the projections get me back to London Open. Let's bring it back. I like when the projections get me back to London Open, and I like when the projections get me back down to sell side liquidity. Notice too, within this time period, look at how it's just consolidating, guys. And people want to tell me that they can trade between midnight and 2 a.m. on a consistent basis, on a day-to-day basis. No, you cannot, because you're going to be throwing this a lot at you, a lot of the times. Throwing this a lot. I don't like to trade those time periods. Just wait for the kill zones to trade. Purge buy side. What are we looking for? What's still available to us? Sell side liquidity. And that's what happens here. And it sells off. Boom. Sells right off. You can even see the same entry technique happens again. Twice above London Open on the 2 minute. Right here. Fair value gap through a swing low. Repeats itself again. And you can also see the structure itself. Breaks a swing high, lower swing high formation, lower swing high formation, lower swing high formation. Let's take this off. Take all of this off because we've seen this already multiple times. So you should be, aware of it. But just look at the price action structure here. Fail to break the high. Lower swing high. Again, another lower swing high. What is it also doing? It's making lower swing lows. Let's make them blue. Lower swing low. It breaks a swing low right here. Another lower swing low. Eventually, you will get higher swing lows, but they might get rated out too. Boom! It raids it again, and it keeps the pattern going. You will get those false breaks though. It's not always going to be perfect, right? That price action delivery is not always going to be perfect. You're going to get raids. You're going to get stopped out. Those trailing stops will get hit. Those that are selling will get knocked out of that. Will get kicked right off the train, kicked right off the boat. And then the market will continue going in that direction. Happens often. Happens very often. Happens to me too. And as much as I want to trail it, I know I will get stopped eventually. And it's okay because I paid myself. I made what I wanted to make that day and I'm done. If I get stopped out, it's not the end of the world. It's just something that it's a constant battle with the market. Constant thing. You're trying to just add hints or find a better way to place your stop loss, or maybe not even moving your stop loss. Sometimes not moving your stop loss at all is really key, to be honest. Moving your stop loss sometimes, and I'm being honest, not moving your stop loss sometimes allows you to hold longer trades. Just being honest, that's what the data shows. Sometimes not moving your stop loss allows you to stay in trades a lot longer. And I say that is because last night, for example, this is the Asian session setup. Same thing. Same thing that we've been watching. That's the entry technique there. Boom. Fair value got through a swing high. Price takes out a 15-minute swing low during the New York lunch session. And then price runs higher. Right? Some drawdown here. Took a while for it to get going. It finally did. Gave us the final TP. Boom. Now I could trail my stop. But imagine if I didn't move my stop loss. Let's just see. Now, let's say I did move my stop loss below some type of low. You're going to notice and see how price runs those lows. runs that low right there, runs these lows here, runs that low as well. And after running all those lows, look, gives you even more profit. And if I had stick to the original stop loss, I'll be able to capture these unrealized gains without getting stopped out. So it's a difficult thing. I try to tell traders in the chat about. It's a difficult thing. If you're able to get a trail, trail it. It's not the end of the world if you get knocked out. It feels good though when your trailing stop doesn't get stopped and price keeps going higher and higher and higher and the profit just keeps coming in. You're raking it in. Sooner or later, you will get stopped. And that's just how it goes. And I believe that is the last thing we had to talk about for the day. Yep. London session, 2-minute entry right there. So we're going to jump on to another topic. The next topic we're going to talk about is going to be our interest rate differentials. Just going to drink a little bit of water. Excuse me. All right. So interest rate differentials. Let's start off with interest rates in general. The primary driver to interest rates the primary driver to the foreign exchange market, the paper fiat currencies that all of us walk around in our wallets and keep in our banks is the interest rates. The rates that the country is holding influences that currency's value. Now, it all depends on what country we're talking about because not all countries are valued the same, unfortunately. It's sad to say it, but it's fact, it's realistic. I didn't make the rules, right? This world is a funny place. It's a messed up world. But we can see in many developed nations, right? Very, modernized nations, the interest rates tend to impact the currency positively and negatively. In other countries that are not so developed or being stripped of their resources, their interest rate does not do anything for their fiat currency. And it might be a little more research that I have to go into for these countries, but we know for the primary developed countries that we know around the world, right? The interest rates tend to really impact the fiat currency, like dollar, yen, Canadian dollar, Swiss franc, Australian dollar, New Zealand dollar. What else we got? Japanese yen. Who else we got there? I said British pound, I think. Euros. Yes. Anything else outside of that, fiat wise, and there might be like a few others, like a handful of others. Everything else is pretty much garbage. It's sad to say, but it's terrible to say honestly. But other fiat currencies just don't hold the same weight compared to the majors, and we all know that. Think about how we trade the FX currencies, right? Think about look on the side, the majors that we have: UCAD, USwissy, GU, AU, EU, NU. Yeah, I forgot New Zealand dollar. New Zealand dollar, right? Japanese yen, UJ. Think about the pairs we trade. We don't really trade some of those exotics. Spreads are way too high. Margins are terrible. We don't trade it, and it's for a reason. Now, when I look for the rates, I use this website. So this is the source I use. You could get this information anywhere publicly. Just go online, quick little search, it's 2024. You have all this information available to you. 2024 tech is at its all-time high. It's only going to keep getting better. You guys can't see the chart. Oh shoot, my phone died. Oh well. So I can't see the chat right now. In 2024, no free advertising. Here we go. 2024 technology is the highest it's ever been, right? Information is spreading like wildfire. Social media platforms are spreading information like wildfire. People are able to connect with people on other side of the planet in literally seconds. So if I have access to this, you can too. Anything you want to know in this world, you can research it. You just got to dig for it. Search. Now, in recent times with the whole inflation and coronavirus and the world shutting down and hyperinflation, this next to the third, what are all the central banks doing in recent time? Increasing their monetary policy rate, right? Increasing their rates. Now, when the rates go up, the yields go up. And when the yields go up, that entices or gets investors invested into that fiat currency. So when you start to see the central banks pivoting their interest rates, moving it up, they're being competitive and they're being strong against inflation, quote unquote, right? I'm not no financial advisor, but I'm just giving you the dummy down version, the watered down version. Someone else can explain it on YouTube for you in a very professional manner. I was giving you the short cut, cookie cutter, clear example. When the rates go up, the yields go up. And when the yields go up, right, the bond yields go up, the investors start to come in, they flood in. But when the rates go down, the yields go down and the investors leave. They go somewhere else where the rates are better. And you can see that translated with certain pairs. Now, when I like to use the interest rates, I'm looking for a great interest rate differential. So I'm taking a currency and another currency and I'm matching it together and seeing how they match up. Are they equally match or sort of match? Or is one very more dominant than the other? Is one superior and is one really weak? And that's what you need to do in selecting certain pairs. Great example right now that we have in recent time. Let's take a look at the Feds, right? The Feds, the central bank in America right now, right? Their current rate is 5.5, or let's just say 5.5. I said the same thing twice. Silly me. And then let's look at the BOE, right? The Bank of England, right? The BOE, the central bank in the UK, 5.25%. These are equally matched, right? Investors are probably bouncing their head left and right, like, should I convert my British pounds to dollars? Or should I convert my dollars to British pounds? It's pretty evenly matched, right? Investors are going to do either or, and they're probably most likely going to be stuck in the middle. They can't make a big decision. It's a hard decision because the interest rate differential is not that big. It's only a point 0.5 difference between the two central banks. So the competition is there, right? But they're evenly matched. But now let's look at how it looks like transcribed onto the chart. Let's go to GU in recent time. So we had this. We talked about this last time. So on our chart here, beginning of the year so far, right? Let's see, when's the last time they changed their rate? 7th. Okay, good. July. Go back. Right around here. It's the last time they changed their rate. Market does trend, right? Then starts to trend back up. And now look at what the market's been doing since December. January. January gave retail traders hell to trade GU. Gave, not to say you couldn't have found setups, but it gave a lot of people headaches because it wasn't definitive in where it wanted to go. It wasn't taking a strong stance because the interest rate differential is not that strong. You're taking two strong currencies. Pound versus dollar is strong versus strong. They're gonna collide. It's like two goats, right? Running their heads against each other, right? They're running and then boom, they buck their head and none of them buckle. Their legs are still underneath each other. None of them fall, right? And they go again, they clash their heads together again. Boom. And they both are still evenly matched. Nothing happens. Nobody buckles. It's the same thing with the investors. The investors are not moving. They're not picking a certain goat to win because they don't know which one is going to most like, or a certain ram to win. They don't know which one is going to falter. Sooner or later, we will know when they start moving the rates again strongly. That doesn't mean that GU is going to consolidate forever. It's just that it's less likely to start picking up speed and moving and being very volatile. You're likely to be stuck in conditions like this, sometimes at months at a time, maybe for 1 month, maybe for 2 months, maybe even 3 months, until you finally get a strong quarterly shift and it has no choice but to move now. And plus the deadline for rates changing or the promises or the speculation of them telling the central bank saying, oh, we're going to cut rates in 2024. It's coming up, and investors are betting on that. And if they really truly believe these central banks to do it, Do they really believe in the Bank of England of doing it? Do they really believe in the Feds of changing the rates? Yes or no? And it will reflect in the price action as well. So January, you see a tough. It's really tough, really tough. But let's look at some other currency pairs that we can probably match up that has a possible stronger difference. It might not be a significant difference, but it might be a larger difference. Let's take a look at another pair. Let's take a look at what is it? Let's see, EU, right? 4.5 versus 5.5, right? That's a whole full percent difference there. Way better interest rate differential compared to the BOE. Instead of it being just a zero point 0.5 difference, there's a full 1% difference. Let's take a look at what EU has been doing thus far in 2024 with its current rate. And we had a couple interest rate decisions come up, right? And many of the central banks have been doing what? They all been saying, yeah, we ain't gonna do nothing. We're just gonna leave it. Inflation is still hot, so we're gonna leave it here. We gotta keep it a little longer than expected. Let's take a look at price was doing. 4.5. Just want to just go back and show you 4.5, 5.5, 5.5, 5.25 put against 5.50. Not not a big difference, but this is the full percent difference. Look at how EU traded for January. More likely to move. Still sluggish in nature. Delete all that stuff. Still sluggish in nature, but overall, still likely to trend. It didn't consolidate the entire month like GU. Still had that slope of distribution going lower, creating lower swing lows, lower swing highs. And when it broke that swing low, it meant it. GU broke a swing low and didn't really mean it. What do I mean by that? Look at GU. It breaks a swing low, doesn't really mean it. Comes back up. Breaks a swing high, doesn't really mean it. Comes back down. It's held in a range. Though eventually it will have to trend. Not saying it's going to sit in the consolidation for months at a time, but eventually it will have to start getting moving. Investors are going to take their speculatory guesses and move the market. The market makers are going to take their guess and say, "Oh, it's time to move it this way. I want the market to go this way." EU more likely to move. Let's take a look at another one. Right, this is a strong versus kind of weak. They're still relatively equal, strong and strong, but EU more likely to move because euro is weaker than the Feds. The ECB, right, European Central Bank, is a little weaker and not as competitive against the Feds in rates. So let's take a look at another currency that we could look at when it comes to the interest rates. So it's not just, see, these are the things that people say, what did I do wrong? Why is the pair that I'm looking not moving? But gold is flying though, but UJ is flying though, and this is flying though. It might be the interest rates that you're not considering. You got to be informed about these things though. So let's take a look. Australian dollar versus this, right? We have a full zero point 0.5, 0.25 difference here, right? A full percent plus a quarter difference here that's going on. So let's take a look at AU. AUD, USD, 2024, January, and going into February. Boom. Look at that. It's more likely to move, right? It's even weaker. Australian dollar, the central bank in Australia has a weaker stance on its rates. It's not as strong as the Feds. I think what's the acronym for the Feds for the bank? RBA, Reserve Bank of Australia, right? The RBA, Reserve Bank of Australia, has a weaker interest rate compared to dollar. Still relatively strong, right? It's still up there, but it's still weaker than the Feds. So you're most likely to see this move instead of it sitting sideways like GU. Looks completely different. If you put it side by side, splitting image, if only TradingView could just be a lot more efficient in its search engine. Oops. Look at the difference there. This is the opening price of the year and the month. Look at the difference. It moves up slightly above the yearly open or the monthly open, and then it sells off. Immediately sells off. Look at GU. Stalls around the open multiple times. It's teeter-tottering. That's a headache to work with. But we could have filtered that out just based on the rates. And this is something ICT teaches. If you're versed in his world and his knowledge, you would have known this, right? If you've gone through his content, his material already, you would have learned this. It's a lot of information out there. I said I give props to ICT. A lot of this stuff he talks long, but hey, it does make a difference. Price sells off dramatically. It's the average trend. You can even see seasonals, right? Start taking some seasonal into this, right? Seasonally, Australian dollar was bearish. Seasonally, DXY was bullish. Plus, we have the interest rate differential between them, which is pretty relatively high compared to the other majors. So, out of all the majors, which one should you have selected to trade for January? AU. And if it wasn't AU, it would have to be EU. And if it wasn't EU, then it was probably nothing else based on that, right? Based on interest rates. And without the confluence of seasonals, just interest rates by itself alone. Now let's look at New Zealand. Now this one is very interesting. 5.5, 5.5, equally match, right? Both rams or both goats are equally match. And I think this is I forgot the acronym for this. I always like to know. I think it's RNZB, something like that. Reserve National. I don't know. I can't remember. But equally matched 5.5, 5.5. This is very interesting to see. Now let's take a look at New Zealand dollar versus US dollar for January. It's very trendy, right? Very trendy. And I was looking at this and I took a couple trades earlier in the year on it. Right? Last up close candle, look for shorts. Up close candle, look for shorts. Got to the target there. Boom. Got it. False break on a buy side liquidity, continues to go short. So it's very interesting. But in order for me to get to this narrative, I had to break a swing low first. That's why you see the caution sign here. And then step after step, day after day after day, I start watching it. And then I start to predict the daily draw. This is why I like to use the interest rate differentials because it helps me understand whether or not I should be using this pair. You can't just say, oh, I'm just going to trade this pair because it was the first pair I ever traded when I started trading Forex. It's not a real objective reason. It sounds pretty subjective. You got to be more objective in what you're doing. Now, that's just my point of view of using interest rate differentials. You take a look at US dollar versus, if you look at all the yen crosses, I love this example because it's really exacerbated. It's really exploited. It's literally exploited. They're taking advantage of the yen right now. I am telling you, for the last 4-5 years, they have been taking advantage of Japanese yen, kicking Japanese yen while it's down. Japanese yen is down bad, dog. Dad. So look, Japanese yen. I know I sound like a broken record because some people have already heard this already. Some people haven't heard this already. and it's their first time watching Forex Fridays, right? Negative rate. That's terrible. That's terrible. And I ask this question all the time, right? Ask any stranger in the world, right? They may not have no financial literacy about investing or saving money or real estate or investing into properties, et cetera, right? But if you ask them a question about this, would you rather have a savings account that has a 5% interest rate yield, right? Yield, right? Or would you have rather have a savings account with a negative rate on it? 10 out of 10 times, most people are going to tell you they want the savings account that's giving them a 5% gain on their money for saving or using that bank. 10 out of time. 10 out of 10 times that person is going to, people will say that. If anybody says that they want to go with the savings account with the negative rate, I don't know what planet they're living on, man. Scared money don't make money, right? That's scared money. That's worse than scared money, honestly. So nobody's trying to bank with Japan. The citizens in Japan will get more bang for their buck when there is tourism from other countries, right? Huge on tourism. Japan is huge on tourism. How do I know? I've never been to Japan, but how do I know that? Because I know other fiat currencies are flowing into Japan. So if I went to Japan with US dollars, right? I took a flight, went to Japan, right? Somewhere in Japan, and I start putting down US dollars and tipping people in US dollars, that's a lot more worthy than them holding Japanese yen. And think about this as well. My US dollars, since I live in America, right? And I'm an American because I was born here, my US dollars will go a lot farther in Japan. I can spend a lot. My purchasing power is a lot higher. And I know many of you folks know this. If you travel the world, you know this. My purchasing power is a lot more higher in Japan with my US currency. Period. Every time. It is not Japanese yen is not more powerful in its own state. But I can go around the world with I could go anywhere around the world right now and have more purchasing power than the citizens that they have locally than the natives in their own country because the dollar is king. I didn't make the rules, right? I just play in the sandbox. I didn't make the rules. I love every country, but this is facts, right? I'm not trying to say any country is better than any other country. I'm not trying to step on anybody's toes, but that's just how the world is set up. We already know. We don't have to get. We can talk about this in a private conversation about how the world was set up and the way it's kind of rigged for certain countries to only win. That's a conversation for another time, and that's probably a conversation I would never have on this channel because I don't want that too much, controversy and too much chatter about certain things. But let's look at UJ. See what UJ's been doing recently. And UJ's been flying, right? See how sensitive it is during certain sessions, right? Beginning of the year. It is taking advantage of Japanese yen. Look at that. Boom, boom. Let's put this side by side with yen. Where you at, yen? It's somewhere here. Bond yields. There we go. Look at this. Side by side. Let's get it matched, looking really nice, so you can see it in its whole shape. Let's scrunch this in, move in a little bit. This over to February. Oh, where we are currently in price. Look at that. Japanese yen is declining. US dollar is rallying. So here as well, I'm showing you correlation. It's not that I have to make a whole separate video for a quick 10-minute video talking about correlations. I can show it here by showing these examples as well. It's opposite to each other. When dollar goes up, yen goes down. Gold goes down. New Zealand dollar goes down. Euro dollar goes down. Canadian dollar goes down. British pound goes down. Swiss franc goes down. Period. That's the market code. But when dollar goes down, all the other currencies on the other side of the world go up. They gain value. Gold starts to go up, right? Even Bitcoin starts to go up. Ethereum starts to go up. And I'm not a big crypto guy. Yeah, I may invest in crypto solely and just buying it and holding it, as an asset. But do I trade it in an account? No, I don't. I just buy and hold it as if I was holding a stock. That's it. I don't know where it's going. I just know, hey, it's a means to beat inflation. That's the only way. If your money ain't working for you, like I'm not a financial advisor, consultant who manages your money and your funds. But if you ain't investing your money, inflation is gonna take it from you. It's legal robbery. We all know it. It's unfair. Inflation is legal robbery to its citizens. Right now, we're not even talking about Forex now. There's a little more life advice. If you are not investing, if you are not becoming a business owner, if you're not getting a way to reduce your taxes legally, right? Through the loopholes legally, if you're not finding a way to have that sitting cash work and earn you money, you're being robbed year after year, month after month. This is how the system is literally designed. Like I said, can't get into those conversations. I would love to, but that's only for those that are really like versed and really want to hear about certain things like that, and also agree with me, because some people may disagree with what I'm talking about. I can't. Yeah, I can't clear this chart. Dang, well, it's looking a little funky right now. I don't. Yeah, it's because it's so scrunched and small on one side. But this is AJ versus Japanese yen. Notice how going into December, going into January, it was going up, it was going up and going up. But then huge sell off, right? But that's where everybody was like, man, Deontay, it's gonna sell. Think again. You really think it's gonna sell while yen is dropping? Why? Why would yen go down and AJ go down at the same time? How is that even logically possible? Not because you guys are one sided. Some folks are just very directional or just ecocentric around one pair, right? Everything revolves around them. Everything revolves around the one pair that they're looking at. This is the end all be all. But we got to understand that it's not the end all be all because these markets are all correlated. And to get more information, to get a better speculation, we need to be looking at other asset pairs. We need to be looking at the stock market. We need to be looking at the Nasdaq. We need to be looking at the yen pairs. We need to be looking at the futures. We need to be looking at commodities. What is gold prices doing? What is wheat prices doing? What is feeder cattle doing? What is cheese doing? What is lumber doing? Those things matter. I may not talk about all of it publicly, but the ones you see me talk about are really important because it allows me to get a better speculation on the market. Many people ask me, "Oh, how did you know that was going to do that?" Well, because of X, Y, and Z. And when I tell them that, they just can't believe it. I'm like, "Have you been watching the daily updates? I've been showing you guys that the yen crosses are all doing the same exact thing. I've been showing these examples for the last 2 years. So of course Deontay might have an edge against certain things. Yes, I may be telling you guys, yes, wait for the confirmation, wait for the higher swing low, wait for the higher swing low. But then you see me do opposite. And I'm in before that swing low even forms. It's experience, guys. I can't teach that. I just can't. Someone asked me how was I able to get there was a UJ trade that I took. Someone asked me how were you able to catch that UJ long? And the swing low didn't even form yet, right? I was able to catch this large candle. I was long every single yen cross, literally. Long AU, long GU. The only yen cross I wasn't let me check my phone's dead. The only yen cross that I wasn't long was I think Swiss J and CAD J. Every other yen pair that I believe so, it was UJ, AJ, GJ, Was it NJ? No, it was. I don't think. No, I think yeah, an NJ. I was long four. I believe it was 4 yen crosses. And I'm still holding it, and I was able to catch this large move up here. Someone asked me, "How did you know that was going to happen?" IQ. It's all about trading IQ. My IQ is just a little higher. My anticipation skills are a little higher. Got a down candle. I got price breaking a previous daily low. I got price trading inside a fair value gap. Most likely a swing low is going to form in this fair value gap. If I see price get back to this candle's high, that could be the threshold for the swing confirmation. The next candle comes up, it doesn't take the low, but it runs the high instead. Oh, this is probably going to keep running. You see it time and time again. Swing lows like to form inside PD arrays. Look at that. Look at this PD array here. What is that? A swing low forms in it. Yes, we do get a false break in there, but notice the swing point at the end of the day still is forming within that range here. Same thing here. Swing point is forming within that range, period. Able to find some type of long setup inside this range. On what given day? Price going on Thursday, another ideal day. So it's not that you're not comprehending it. It's just that I'm just a little ahead of the curve right now, and you will be too. And I'm rooting for you guys. This is why I teach it. Your anticipation skills will only get better as you learn the concepts. You'll be able to take advantage of these things. So hopefully that is insightful. And if we just take a quick look, like let me go down. AJ trending up, and we're tracking AJ right now. Like I said, I started off the first year strong versus weak. We got that. I'm anticipating what? Some type of higher swing low to form. And I said, if we don't get a higher swing low, price could just keep giving up days. And then we might even have one down day. And after that down day, you know what I'm doing? I'm buying. I'm buying because that's an indication. It's cheap in the trend. And that if a leg is going up and we get a down leg, I'm gonna buy against that. I want to. Because data has proven that buying in an uptrend after down days tends to be successful. And that's a fact. Nobody can argue with that against me. Look at this uptrend. You're telling me there was not case scenarios after down days where if you would have just brought after the down day, you would have been profitable. And I'm not talking about where your stop loss would have been or where your TP would have been. I'm just talking about an overall projection. If you would have brought after a down day, you're telling me there's no profitability in that? Because you would be wrong if you told me no. Yes, there are going to be days where you take losers. But then at times, if the market is going to trend higher, those losers mean nothing because you're going to be able to hold it longer than most folks. You're going to see that the trend is still trending higher and you buy and you buy and you buy. And if the market is trending bullish, what can you just do? Buy every day below midnight opening price. Buy every day below London Open. Buy every day below New York Open and aim for the previous daily high. Someone had asked me, how do you figure out the daily draw? We spoke about it multiple times already. Swing high broken, wait for a higher swing low. And if it's not a swing high broken, it's a fail of a lower swing low and price continues going higher in that trend or vice versa. And then you wait for what? A down candle. Look at this. Look at this up leg here. One up leg. Look at how it gives one down candle. After that one down candle, you got 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 bullish days. 9 bullish days. And you would have to have the draw right and higher time frame premise and understanding, okay, June is most likely going to be bullish and however you arrive there. But with hindsight data, you can see if it's going to trend higher, you would buy after a down day. And if it's going to continue the trend, you're going to look for price to raid previous daily highs. Let's take a look at this. Previous daily high broken. Previous daily high broken. Price fails to, previous daily high broken. Price fails to break this high. Inside bar. Candle. It's inside this candle's high and low. The next day, it breaks up that way. Previous daily high broken. Previous daily high broken. You telling me you can't find daily draw? Previous daily high broken. Previous daily high broken. Previous daily high broken. I sound like a broken record. Previous daily high broken. Draw on liquidity. It's bullish. So what are you going to be aiming for? The previous daily high, guys. If it's bearish, what's your easiest draw on liquidity? The previous daily low. If it's going to sell, it's going to target previous daily lows. If it's going to buy, it's going to target previous daily highs. You will get those scenarios where the market will throw false breaks at you. It will do that. And surprisingly, we don't get any in this run here, because it could easily did this, break a high, and then the next day breaks the low. Then it goes back up long, and then long again, and then long again. Then it breaks a low, and then it goes back long. But in those formations, what is it doing? Creating swing lows. Right? Isn't that funny? It all just adds up. Making swing lows, getting traders on the wrong side. So let's move on to the next topic. So that's interest rate differentials, and a little bit on identifying trends. But we're going to take it a step further. Right? We're going to take it a step further. Let's look at U.S. oil, because this is something I tracked last month. I still have the annotations on it. I do. I'm not going to delete it because it's just clean. It's just clean order flow. It's really clean. Oh, I'm going to have to do this on a new chart. U.S. oil daily chart. Come here. Okay, perfect. Let's go back to the beginning of the year here. Clean slate, right? I'm not even going to use IPTA here. Clean slate. How are we finding a trend? Finding trend or identifying trend. Okay, in most recent time, what can we see going into the new year? We could see that price broke a swing low. Okay, fair. That's fair. And there's also a swing high up here. So we broke a swing low. According to Deontay's bearish trend formula, breaking a swing low means bearish momentum. And after breaking a swing low, in order to see confirmation of it price going lower, we should see a lower swing high. Do we get that? We do get a lower swing high. Okay, cool. We should be looking for shorts at this point, right? The bias should be looking for shorts. What happens instead? Price breaks a swing high that it just created. So that goes right out the window. Now, two things should be running through your mind. Is this a false break, or is this now bullish momentum coming into the market? You would have to wait for confirmation if you are not sure. Meaning you need to wait for a higher swing low to form. Or you would have to wait to see if price is going to come down and take out this swing low. Because if it takes out this swing low now, after taking out that swing high, that means this is all just bluff. This run back up here was just bluff. Because if it runs back down here, then it's probably going to continue selling off. Price does what? It's still trading higher. But we're waiting for what? A higher swing low. Because we broke a swing high. So let's go through the steps here. So where we are currently now, we broke a swing high. So what should we be waiting for? A higher swing low. So this is the recent swing low that we have after breaking that swing high. We should not see this low broken if it's going to trade higher and create a swing low. Okay, cool. What is this? In theory, it is a swing low. Is it confirmed yet? No, it's not confirmed. So we're waiting still. Or if you're like me and you have IQ, right? A little higher trading IQ, you can be a little more aggressive. And you can say, I know that this is going to run up and confirm this swing high. So you could probably look for longs. But if you're someone that is still learning the idea of how the market works, wait for the confirmation. Be sure. Price trades up, takes out the previous daily high. Price still trading up, trades up after a down candle. So it's giving insight. Oh, down candle, and an immediate push and engulf of this candle. That's really interesting. And now price finally confirms this higher swing low. And while it's doing that, it also does what? Breaks another swing high. So it's showing you stance is what? Bullish. Stance is now it's more likely, it's definitely bullish. we can have more conviction and confidence going into the market. We should be buying. What can I do? Buy after a down day. And this down day happens to be what? A small candle. So we could buy going into Monday. Not something I would ideally like to see, but it could still be a feasible idea. We could buy going into Monday. It's a small candle. Let's see what happens the next day. We don't get that buying opportunity. So say we take a loser. Take a loser. Cool. Next day, Monday's a down candle, and we're going into Tuesday, an ideal trading day. Great. We also broke a swing high. So we should be seeing another swing low formation forming, or we should just be seeing bullish being hyperbolic and just trading higher. And we can see this is potentially going to be a higher swing low. Higher swing low forms. Again. And you can see they don't want to run the swing lows. Protected, protected, protected. But what's not protected here on the flip side? The swing highs. That's all game, right? That's taking candy from a baby. But this is like a mother protecting its baby. They don't want nobody coming near their child. Up. But then we got a fall. Like I said, we had that false break. And we read that too during the daily bias updates. We read this too. We said, is this going to now be a switch back down to bearish momentum? Or is price just doing that to get traders on the wrong side? And we said we need more data. We want to see if it's going to create a lower swing high formation now. We need to see that. If it doesn't create a lower swing high but breaks this recent swing high, then it was all bluff. It's all bluff. It's all bluff. Now I know, okay, breaks a swing high. Okay, it's bullish. So I could be targeting previous daily highs, or I wait for a down candle, then buy after it. Down candle. What can I do after this down candle? I should look to buy after this down candle. Where could I be projecting for? The previous daily high or a swing high that is still unbroken? Boom. Runs up and takes it out. You can see it does take out the previous daily low. And I said that happens sometimes in a trending environment. You'll get those days where price takes out the low and still continues trading higher. Another down day. What could you do after this? You could buy. Ta-da. Another one. And it keeps trending now. The lows are now protected. Low protected, low protected, low protected, low protected. High. This high wasn't rated here because it was an inside bar. But next candle does raise that high and also raise this high. So in one candle, it takes out this high and this high, 2 days high. I like to see when one candle takes out 2 days worth of data, whether it's highs or low. That gives me more conviction that the market's going to go in that direction. So the next day, I could be heavily long or risk more that day. And you can see it runs up. And where does it run to? That swing high that we talked about all the way back in December. All the way in December. It's not an easy process when you're first learning this, but the steps I'm giving you is cookie cutter like, and you're able to place it here, and be like, okay, this makes sense. This makes sense. If it breaks the low, wait for this to happen. If it breaks the high, wait for this to happen. But if it breaks a high and this doesn't happen, then it's fake. If it breaks the low and this doesn't happen, oh, then it's a fake break. And that's how we start to identify the trends seasonally too, right? Let's take the seasonal chart. Seasonally, January wasn't much. And I said before, I picked oil just to prove to the community that it doesn't matter what I'm looking at. Doesn't matter what I'm looking at. You can do it. Sometimes it may be more difficult. Like imagine if I would have picked GU for January. Oh my gosh. That would have been a terrible month for me to be doing daily tracking, you know? It would have looked like I didn't know what I was talking about. But in all honesty, it's not up to me. It's up to the market. That market condition was terrible. The interest rate differential was too even. It was literally none, right? So GU would have been a terrible pair to trade for January. But oil happened to be a better asset to trade, crude oil, than GU because it was trending. And then going into February, we see strong bullishness. March, huge decline. Then going into April, bullishness all the way up into July. Potentially, it should be bullish. Now, does that mean the seasonal tendencies is going to read the same way for the entire year? No, because some months will say February's up, but instead February might close down and might give price action lower instead. That means it's going all against the seasonal tendency, so you know something's up. So you got to be paying attention real closely at that point. Last year, those folks that have been tracking with me or been with me since last year, you guys know that 2022 was probably one of the cleanest years to trade. Cleanest years to trade, man. Crazy. Especially because of the interest rate raising. The market was volatile, moving. The yields are changing. Investors are coming in. And now that we're kind of at this standstill, things are getting a little boring in the FX currency world, right? Things are not moving as volatile as we want it to against the majors, but they will again eventually pick back up. That's why you got to take advantage of what we have in history. Take advantage of the yen being weak. Take advantage of that. Trade the yen crosses. Take your shot at it. I'm not saying pick UJ because you see me pick UJ. Pick whatever one you want to pair. You want to take. You can do as you please. Now let's look at something else too. Let's look at Zillion dollar. Bearish, right? Bearish. Besides the interest rate differential literally being even with the Feds, just take a look. It was bearish. Now let's take a look at New Zealand dollar. And we'll look at gold for an example, just to see how you would have probably walked yourself through that. Just look at the way this forms, right? Swing low broken, lower swing high, price sells off. After the up candles, there was possibly a sell opportunity that could unfold. Up, huge sell off going into February. Now we got what price turning around, right? Is this a change in trend, or is this just a false break to get the retail traders on the wrong side of the monthly candle? And then next week, the next couple weeks, it turns back around and it goes down, where it comes up and then sells off again. Possible, right? Those are possible scenarios. But just look at how it is forming to get down to where it's at currently, from the end of December going into the new year and then lower. That's a very clean price action there, folks. Doesn't get any better than that. Doesn't. I love environments like this because it makes things a lot more easier and concise for me to catch draws and catching one-sided movements. Sell side is being targeted, not buy side. You have those little glimpses of, oh, raid the high and then it sells off. You can't catch all those. But you could anticipate, right? This is a tip. You could anticipate if it runs a high, sell at the high. If it's in a bearish trend, it's a strong bearish trend. You know it's going short. If price breaks the previous daily high going into a Tuesday or going into a Wednesday or even a Thursday, sell around the high. Find some type of selling opportunity around the high. And you'll see you could be rewarded. So we're going to move on to the next topic. I'm just going to drink a glass of water. The last topic, we're going to talk about smash day candles, and then we're going to jump into Q&As, and then we're going to enjoy the weekend. All right. The easiest way to explain this is on the daily chart first. So let's jump to the daily chart. Let's do it on. Let's do it on. No, not the layout. Let's do it on this. All right. So DXY. All right. You can see also DXY opposite, just trading higher. Let's clear all this out. Now, Larry Williams' idea or his methodology of the smash day candle, and this is where I think ICT kind of got that influence to come up with the order block as well. And if you do your research, you'll start to see like, wow, this does look like order block theory as well. When you have a candle, Larry said, that closes well below several lows, he didn't specify in his book, And I have, if you want the book, I have the whole PDF. If you want the PDF, DM me. We can ask anybody in the chat. You'll get the whole PDF book. Go through the book, read the book. I read the book almost like 5 times already. Every time I read the book, I find something new. I go back, I apply it, and I'm just like, wow, Larry Williams is a genius, man. And it's all no indicator based, no trend based, just natural studying. When you get a candle that closes below several lows, Larry Williams says, right? That is a potential pivotal point. And the reason why is because in this example, I'm showing a bearish smash candle, right? Meaning a down candle. This looks like the sky is falling. It looks like dollar is just completely falling out, just getting out of a bad breakup. It's going through a lot of turmoil, etc., etc. It just looks horrible, right? Sky is falling. Retail traders are going to be highly optimistic and follow this. They're going to chase this with conviction. And at said point, they are going to get burned, period. Because the market is going to turn around on them so fast that they're not likely to anticipate it, which is why Larry Williams called it a smash candle. Read the book. It is going to smash all the sellers chasing the down closes. This to a retail trader, this candle in itself and how it's forming here, it very much looks bearish. Just the close. We're not looking at the low or the wicks. Just the close in the nature where it's closing like outside the range, outside all these lows, outside below these swing lows. Looks bearish. Retail does what? They chase this. Now, Larry Williams says if you ever get the opportunity for a candle to close outside of a range, this could be a potential opportunity for a buy setup. All you have to do is place a buy stop at the candle's high. Now, I could sit here and argue you can also place it at the close. I mean, at the open if you really wanted to. But I'm just going off of the book. The book says place a buy stop here. Buy stop order. Right here at the high. Because if price is going to turn around here, it's also going to be making a swing low. See? Also going to be making a swing low in this pattern. And it's going to catch everybody to the downside off guard. So if price returns there, you go long. Where you place your stop loss, that's all up to you. Don't take my word for it because this is something that I believe still needs work. And I believe that Larry Williams should have specified on the stop loss, but I guess he's leaving it up to the operator or the trader themselves, right? Leaving up to the user to figure out what stop loss they would like to use for this model and what smash candles they would like to take. Maybe this candle's too large, right? And it just doesn't fit your risk parameter the way you want to use your stop loss. So you can't take this one. You want a smaller smash candle, whatever the case may be. If price returns back to that candle's high, right? Even if the low is broken, if price returns back to that candle's high, that could be a long opportunity. And look at how it blasts right through that high. Isn't that interesting? So you know for sure the sellers got it wrong. Because look how strong it turns around. It even makes a volume imbalance. These two candles right here, right? Not touching. Price creates a volume imbalance right there. And all the sellers are completely wiped out. All their sell stops, right? Correction, their buy stops are all knocked out and triggered in for longs, right? And we're using their buy stops to place our buy stop order to be triggered in on strength, and you hold for higher prices. At times, this is a very strong setup, depending on where the quarterly shift is occurring, but depending on what time of the year it's occurring, depending on what month it's occurring. I believe it's a very strong setup based on certain things aligning. And it could be a huge run sometimes. And it could be a turning point that allows you to capture hundreds of pips just off of this here. Going long right there. Look at where price is. Ridiculous. Just off of this. Just that one candle. If price does not return back to the high, there's no opportunity. The order is not filled. Not at all. For example, here too. Look at this. Down candle, down close candle. Does price ever get back to this candle's high within the next couple days? No, it doesn't. So we wouldn't consider it. Do we get another candle that closes way below it as well? So we can't consider this as a smash candle anymore because this is the most recent smash candle. So we'll take this one. Does price return to its high? No, so we can't take it. Do we have another recent smash candle as well? This one. It closes below this candle's low. Even though it's just one daily low, it's still a smash candle in theory. Does price return back to its candle's high? No. So we don't have any long opportunity. Another smash candle appears. It closes below several lows here. Does price return to its high in the next couple days? No, it does not. Without a new smash candle forming? No. This is not a smash. This is a smash candle, actually. Is it? Yeah, this is a smash candle. Does price get back to its high? No. Is this a smash candle? No, it's not. This is not a smash candle because the close is not below lows. It's inside this candle's range. High to low, this candle is inside this candle's range. This is a smash candle. Do we get an opportunity to go long on this one? Yes, we do, because price returns back to its high without creating a new lower smash candle. Price gets back up to it long. Boom, takes off. Now, same idea that I'm showing you can occur on the 4 minute, 4 minute too, the 4 hour, the weekly, the monthly, the yearly, etc. I want to show you guys this idea on the 1 minute via kill zones. So let's take a look at London here. And I want you to look at the peak of London and tell me what you see. The highest point of London before it really turns around heavily. This is the highest high we had for London. Notice we have a smash candle, but it's inverse to what we're saying. So what I just showed you on a daily, just take it in vice versa. We've got an up candle closing above highs. Look at this 1 minute candle. It closes above several highs. It's also above the London Open, midnight opening price, Sunday's opening price. And when price returns back to its candle's low, there's a sell-off here. Even in the means of a fair value gap too. Fair value gap, boom. Another fair value gap, another fair value gap, liquidity void. Just straight down. After this candle is printed, we get a liquidity void within the next 5 minutes. 1, 2, 3, 4, 5, 6. Within the next 6 minutes, we get a huge turning point, getting closer to 3 a.m. and price turns around and sells off. Now, how could you use this as a selling opportunity? Well, you would go short here. If once price hits that, you're triggered in short, and you can place a stop loss right at that candle's high. So you're not stopped out here, and you're not even long here, right? Just because you see the candle's high is broken doesn't mean you're long there. You're only long once it triggers you in right here at that candle's low. Now you're in long. You're not stopped. Just to clarify so it doesn't look confusing. Now you're in short, and you can hold that. Now, what risk parameters can you take besides just placing it at the high? The classic 15 pip one. 6. Right? 15 pips for 15 pips off that smash candle. Press play. TP hit. Now, this entry is the best entry possible because it's the exact turning point. This is why I said Larry Williams was a genius for this idea and the way he's thinking about how to enter the market and how the market shows that turning point. Genius. You could look at any other candle that almost looks like an opportunity as well. Look at this one. Look at this smash candle. This candle closes above several highs. Same idea. If you went short here, say 1-to-1, say we're using 15 pips. Zoom out. Same idea. Might have not been the best sell, but it's definitely a turning point there that you were trying to catch there. You would have been in profit for a while, and you might have been nervous, but if you believed in the model or the idea, you would have end up in a winner. Let's take a look at another example here that we can see on the 1 minute. You can see one here, right? Look at this candle comes up, closes above highs, price returns back to its low. That's a selling opportunity. Sells lower. Same thing here. It's a really small, subtle thing, especially on the lower time frame. 1 minute candle. Look at the close. And look how price quickly too. Ooh, large candle after it. Phew. Sells off quickly. Sells off very quickly. And that's an idea of the smash day candle via 1 minute. You can find this on a 2 minute. You can find this on the 4 hour. We were showing this on the 4 hour for US oil too. We were showing this on the 4 hour for US oil at some point. Right? Look at this. This candle closes below these two lows here. That's good enough. Cool. We got the signal. All we're waiting for now is not to get another candle that closes lower than this one and outside of that one, because then that new candle would become the new potential smash candle. So this is the only smash candle we're looking at. And look at how price gets back to that candle's high and never returns back to that candle's low. Well, actually, we would have to see which way this went first. Because price opens, we don't know if it ran up first and then dropped, or if it dropped first and then went up. But just looking at the idea, you can see how that down candle happens to be the turning point, right? Or the pivotal moment where price continues to trend higher. Same thing here. Look at this 4 hour candle. This 4 hour candle closes above this candle's low. So boom, it meets the parameter. It closes below some type of low. Now, I don't know if the more lows, the better, because Larry Williams did not specify that in his book. That's up for you to do your research and do diligence and back testing. But we can see in the ideology and the methodology, it closes below the low, buy at the high. Quick turnaround. The next candle completely engulfs it, crushing all the sellers that were in this 4 hour candle, thinking that the next 4 hour candle was going to sell. Runs back up. And that run back up continues to trend for a couple more hours and a couple more days, for the next 2 days. Next day, actually, because the 8th going into the next day. Technically, half day is Friday. But yeah, that's a smash day idea. Take a look again. Let's go back to, I think there was another pair. It was UJ, I believe, or was it DXY? Yep, DXY. So we have one in New York, right? They're everywhere. They're everywhere. It's very subtle nuances. 1 minute, boom. Look at the high. I want you to look at the highest high for the New York session. Tell me a smash candle did not start that trend. This is the highest high for New York session. Right there. This candle closes above several highs. A high is fine as well, like I said. And once price gets back down to that low, there goes that pivotal moment right there. That's the smash candle, guys. Right there. It closes. I hope I'm not confusing anybody, because I think it's really direct and clear what I'm saying here. This candle is closing above highs. This high, this high, this high, this high, this high, this high. It doesn't have to be multiple highs. Once it closes above any high, it is valid. The setup is now pending. If price gets back to that candle's low, that's where you're going to go short. Stop loss could be a 1-to-1, 15 pips for 15 pips, or the stop loss just goes back to the candle's high. That could be also another parameter you want to use as your stop loss. And notice from that one moment in time, that was the pivotal moment. Sells off. Sells off. And you'll see it time and time again. When you get those candles that close outside the highs, this candle here, same thing. This candle closes outside the highs. It's an up candle. Price returns back to its low. And I think some of you might have heard me say this. When I like to pyramid, I like to see up candles to form because it's the same thing on the daily. If it's going to sell, I want to sell after up 1 minute candles. 1 minute candle up, even if it doesn't close. Now, this is kind of outside of the smash candle ideology. This is just me giving more advice and just understanding the trading IQ here. Even if I get an up candle and it doesn't close above the highs like Larry Williams says, it can still be used as a opportunity to say, what happens after up candles in a downtrend on the daily? It sells. So could the same thing be said on the 1 minute? Yes. So it's trending lower. We get 1 minute that's up. I could sell after this 1 minute candle. Up. I could sell after this 1 minute candle. 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 And then at times you'll see that it will go again to eventually. Sooner or later, it will go eventually. And the trend will change again. The trend will change again. Look at how this small little influx right here, this rally up, this little small leg. Look at how it starts from what? A smash candle again. Daily. A 1 minute candle that closes below lows, price turns around and hits the high, runs up. And look how similar that looks to the daily chart that we were looking at. It even makes a volume imbalance too here. It looks just like this. It's so crazy. It looks just like this, but just on the daily chart. And this is the 1 minute chart. So you see how price is clearly fractal and coded, not random. And then that new trend unfolds. And then once you start looking at the top and lows of the trends, you start to see, oh, this is how it's turning around. And this is how I could potentially catch it. Yeah, it's very powerful. So hopefully you find this insightful. If you guys have any questions at all, please let me know. I think I'm gonna leave it off here. Yeah, this was a great night. It's 11:59, so about to probably stuff my face and jump right into bed. Let's check the chat real quick. Shout out to the chat. Yo, shout out to everybody that's here tonight, man. I don't know where you guys are in the world. Shout out to your country. Shout out to your people. Shout out to your religion. Shout out to your culture, etc. But y'all not doing no bad stuff to people, you know what I mean? But shout out to you and your family, your loved one. Facts. Catching the trend. You need the PDF, fam? I got you. Got you. Yo, make sure to DM me about that. I got you. Just shoot me a text on Telegram. I'll send you over a copy. No doubt. I'm glad to see that the Asian session model was hitting for you, man. It's not the best, like I said. There's probably models that are better than mine's, but man, I'm getting older, man, and I ain't even that old. But man, I want trading to be so seamless, dog. Like I want it to be seamless, bro. I don't need to be wasting any energy when it comes to these markets, bro. I got other things that are so much more important than sitting here in front of this chart and being a slave to price action. I'm tired of that. And it just took me a couple years to figure out, man, how can I make this as easy as possible for myself? And I said, bro, you need to pick one kill zone. Bro, you need to pick one entry technique and you need to do it efficiently. And you need to risk a certain amount every time. Done. Move on. You're done with that. You figured out how to trade, Deontay. And you win, right? You win the week, you win the month, you win the year, you win life. And you keep pushing on, man. You keep pushing on. All right. I think we're gonna end it on a good note, man. No more rants from Deontay. Fam, it's been a pleasure, as always. Leave the indicators alone. Peace. Love.